Talk to me honestly. I'm here. I'm here. Talk to me. I'm here. I've been so far away. I don't know when I changed. Your voice replaying in my mind. I'm not perfect.
What's up, everybody? Good morning. Money Tech, Will, Terrence, Brett, JX, guys. Getting started. Nice. Rational start pre-market. Make sure you guys have all updated the risk intervals in the bot. In the PD calculation. You had those updates this weekend. For the first time in a little bit, we've actually had a change in the S&P. I'm going to change the VIX, so change all of them all. Go over that in a little bit. FOMC today. Yeah, markets like the stable, rational. You know how FOMC goes. Trading at FOMC is pretty simple. There's a routine. I'll go over all the tricks. Simple as in, don't do anything until about 1:30. If you do anything at all. Simple to just know the markets can do anything. Been doing this for a long time. I can assure you, got enough fed. Y'all hang tight, get started. I'm gonna chow down on my breakfast here and drink my Celsius. I'm prepared here. All right, some cool new updates coming out for Rocket Ski. We'll talk about those today too. Big master plans to take over the world. All right, checking out, getting my screens oriented here. About to do some major updates when it comes to, we have screen layout. We have some cool things coming out on the dashboard for y'all. It's gonna be really neat. We had a patch last night, the alerts. When we reorganize how the alerts look, we just something to take in the patch. They froze yesterday. They should be good now too. The alerts window should be good. Plus, I pinged the data providers and I went all the way up to the top, as high as I can go. The music is blasting, huh? And basically, they might have fixed Meta, so we're gonna have to look at it. They had an issue with Meta, what's causing our hedge pressures to be a little wacky. They're giving us bad data. I said they fixed it, so hopefully Meta looks good today. Go to breakfast. Listen, I know it sounds really unhealthy, but I buy these like Jimmy Dean breakfast sandwiches, like croissant, egg, cheese, and sausage. It's like so tasty and so gross and so fatty and probably so bad for me, but I don't care. Love it. My normal go-to breakfast healthy is like a protein bar or protein shake, something that's like, you know, healthy-ish. I'm trying to get healthy or healthier. I'm working out every day. I'm getting in hella good shape though for summer, but still, I need to get my blood pressure down. I'm an old man. Which else get to breakfasts? I normally don't eat breakfast if I don't. So if I have a choice, I don't like to eat food unless like I pick one meal a day. It would be like dinner or like a pre-workout carb load or something. Water's good, yeah. Drinking a lot of water is good. I know I need to be better at that. All right, taking a look at the pre-market, just looking at things right here. We're inside the DD bands. Everybody, make sure. A lot of times, like Nicole will wake up and make me some fried rice or something, because like a lot of times they always have like leftover food and rice and stuff, and so like I'll hear like the sizzling from the kitchen. I'll go and I'll be like, ooh, it's some like spam fried rice or something. Oh my, ooh, that's good. But again, salty shit. I gotta start being better at that. DD bands, QQQ, or sorry, Nasdaq, S&P, Russell, all clean. Remember, risk intervals have changed. Risk intervals on all three index products changed. Make sure you update your risk intervals if you're using them. They've all changed. We're 2.6 on VIX right now. We also have a new triple B on VIX. Let's go ahead and do it. I didn't update it. Bad, Matt. I got busy yesterday working out to save my life. Out there trying to get my BP lowered. So I went to try out a new gym yesterday. It's a place called True Fusion. I don't know if y'all been there before. They have like multiple types of things there. They got like interval training, kickboxing, yoga, Pilates, like a little bit of everything. So yeah, we're trying that place out for a little bit, see what they have. So I went to some kind of like interval training workshop type class thing yesterday. All right, let's go. It's there. Right there. VIX options expire this morning. $22.17. That looks familiar. I think somebody said that in chat last night. Let's pop it forward. You guys are awesome. I love that y'all are on top of stuff. Maybe April contracts, so make sure we label this and make this from the big bold. April. Let me read what y'all are saying. Fried egg sandwich, jalapenos, relish. Bro, that is a workout treat. That sounds tasty. You do water fast first hour of the day or something rich in protein, low carb, eliminate the midday slump. Yeah, 100%, man. If I eat in the morning like something heavy, and this is really heavy, like high fat content, which is, you know, I only like to eat this tiny little breakfast sandwich. And that gets me all day. I don't eat anything else, and I don't snack. What's up? What's up, Brian? Good morning. Okay, so let's get back. I'm still trying to do this like, again, showing off just this like financial eval thing. My 100K challenge account, people ask about that. Still going. I got put on another screen. Still killing it. Still at account highs. There's the account number. There's a balance. Started at 10K. It's at 20K. So this is the 100K account. Still going. Oh yeah, I'm crushing all things. I passed the 150 eval. Now I'm killing it 150 elite. And doing the 250 eval. So I'm $2,500 away from a 15K profit. Dude, just crushing it, man. Having a good time. So yeah, I'm up over 100% on the small account. Still doing it. I'm mirroring my trades in all the places. I'm juggling like five different things, I feel like. Or 3 different things. 3 different trade baits. And then I got the Discord and the platform. I should be in the circus with all this juggling I'm doing. I should join Cirque du Soleil. Do I trade 100K different than the eval? Nope. Same. Roughly the same. I take a little more risk in my personal account. I allow myself 15% drawdown, give or take, on a single trade. or single day, like my career trade, I go in heavy enough. Why did I make America up here? I take my net lick divided by the margin requirement. So it's currently about 2 contracts on the main account. You have 2 contracts, the maximum, not 15K every trade, but the maximum. I always pull the plug at stop loss. Usually about 10 points, right? I make it to where if I lose a risk interval, which is like a catalyst comes against me and I drop, 30 whatever points. 2 contracts at 30 points is 3 grand. 3 grand on 20 is 15%. So in the worst event, a catalyst, I make sure my position size is a very simple rule. And that rule is how I've been crushing these evals. Like literally, like I'm going to teach you guys, I'm going to teach everybody in this how to go crush these evals. It's going to be fun. Here's a rule. You take your net lick of your account and futures account divided by the initial margin requirement set by CME group, which is equal to 1.1 times the maintenance requirement. That equation gives you a max contract you want to have, basically the cash balance of your account, such that a 1 risk interval move, which is the biggest move you're going to see typically without, the market will move straight, 30 point, whatever the risk interval, the new one is 31 points, I think. I gotta double check it. And what happens is if you move that much, like the market is you're just moving along and there's a random tweet or a random news event, market just drops or goes a direction, usually goes a risk interval, right? We know that from the catalyst class. And so if I use this equation, it's perfectly balanced to do the following. If you do the math, if the net lick, let's just do an example. The net lick, I'm gonna make up a number, 22,000. And the margin requirement is 11,000, okay? And your broker gives you $500 a contract. You're dumb if you do this. You're smart if you do this. Don't treat it like you can get $500 a contract. Treat it like you gotta pay the full price. Don't go in there and go, oh, $500 a contract. I can buy 44 of those things. Let's go to the moon. No. Do this. Don't borrow money to trade. Pay what clearing needs yourself. 2 contracts. Because if I do 2 contracts, remember the S&P is $500 for every $10 points, right? And if a sudden risk interval drop goes against you, right? Half a doomsday ban, which is pretty much my oops, something happened, it goes against me, let me just close out. Remember, that's the rule that I pull the ripcord if nothing else stops me out. So a catalyst will come out of nowhere and boom, I hit a risk interval, right? So what happens is the rarity of an event, that's a rare event, once in a month or something, you get caught in a catalyst or maybe less. So in the rare event, this equation gives me the following. It's $500 to every 10 points. And I did this equation, allows me to have 2 contracts. And the risk interval is 30 points. Let's do the math. 10 points goes into 30 3 times. So that loss, if I was upside down, is $1,500 per contract. And my maximum was 2. Times 2 is equal to 3,000. If I do this equation, 3,000 divided by 22 is roughly 15%, give or take. It's like 1 out, well, actually, no, wait, 3 times 7. So it's 14. Let's say 3 out of 21, it's about 14%. 14.5%. So close to 15. So in the worst case scenario, I'm going to trade and some random news event kicks me the other way, which is rare on a once a month type of basis. If I'm happen to be in a trade, like once a month type basis is that an event comes out while I'm in a trade. Usually I'm in and out and I miss the events all the time. But this rule makes it to where in the worst case scenario, it's 15%. So I have a max amount of accounts or contract value to keep myself from having a risk interval drop. Do you understand the importance of the risk interval drop? Benji, you should know that, right? Which is rare, right? It's rare that a spontaneous event, unplanned event comes out of nowhere. When Trump was president, they come out of nowhere all the time. And that's what made me invent a rule like that, right? You wake up to a tweet and he's like, we're putting sanctions on this country, trade war with China. And it's just like the market just drops out of nowhere, right? We know that move is typically a risk interval, correct? Yes, we're on the same page. Y'all got to know that. right? It's not, it hits a risk interval before it stalls and then it keeps going. So that risk interval quick drop is where I get a chance to pull the plug. So if it just drops that risk interval distance, the first catalyst run, I didn't blow up the account. So that's the whole point of an instant event doesn't blow you up. Now the market can continue to collapse really quick, but almost every single time, no matter how bad the event is, it pauses at a risk interval before it keeps going. It gives you enough time to be like, oh shit, I gotta pull the plug. So that equation is what I use, a similar equation to balance the position I want. But instead with these eval accounts, all I do is fix the drawdown. So if they say the drawdown is $4,000, then I make sure that what's the number of contracts it takes to lose $4,000. Oh, I did a calculation. It's currently like, you know, whatever it is. You want to see the secret numbers? Here we go. Here's some. I did a spreadsheet like this and I taught this in a class. And if you guys go sign up for the extended trial, you will learn this because there is a class that we taught on this. This right here, this was a 250, now it's at 262, right? This is just, I'm just testing it out. I'm probably not going to use the account once I get to the end and just get in there just to do it. This is the secret to the 250 eval. I did this little tool. My max size for one RI is confidence of 2.9 contracts to not break the drawdown limit or daily loss limit. And if I lose multiple days in a row at this, it takes 4 days or 4 or 5 days to bust on max DD. And of course, you never see me lose 5 days in a row. It's rare. I'm about an 80% win rate and I trade about once a day. So and a bad losing streak is possible, but if I'm only 20% loss, I'm going to double that and say I lose. Okay, let's just worst case scenario, I lose 2 days and win 3. I'm not gonna bust 5. That'd be rare for me to bust 5 days in a row. I'd be wrong 5 days in a row, right? So it happened. Of course, it happens. Trading is all, you know. Sometimes you get unlucky, but still. There's all math to how you beat these things, and I've just walked in and just smashed. I smashed the first one. The elite is made what, $2,300. Then I'm smashing the second one, and then yeah, it's all about controlling your position size and knowing how markets move and knowing the risk intervals. That's the trick. That is the trick you want. Promise. Market open 2 minutes. It's ready to go. We'll run the DD bot really quick so I can convert these on SPY. I'm probably gonna make any trades out the door. Keep that in mind. And my predictions is that the FOMC could very well go to 0 basis point, which means I'd like to get a dip. I know there's not a popular opinion right now, but I thought it was popular. I thought it was possible that the Fed ease up and stop doing anything until we're fully realized on QT and that balance sheet's fully rolled off. All the things are gonna roll off. How's that risk interval trading view? Yeah. There is in our Discord a member-made tools section that somebody made that allows you to. I've never used it in TradingView, so I'm not sure how it works. But if there's got to be an input in there somewhere, you just need to take the number from the bot and input it in to your tool. So that y'all know where to get them in the bot. In the Discord, it's pretty simple. Go down to something called bots and indicators, and you'll come here. Bots and indicators down here. Down at the bottom, bots, indicators, risk interval. You get the last number, and then ES is 30. Okay, it's 31 now. VIX is 2.6, etc., etc. Yeah, it's 31 now. So everybody, make sure you guys update your stuff. I'm testing something on my stream, so I'm not going to kick the refresh button just yet. I'm testing something to see. So probably no trades until FOMC. There's a video explaining the risk interval. It should be in... Oh, you know what? The DD band has the risk interval use for DD band. The VIX risk interval has the use for the VIX risk interval. A tutorial on what the risk interval is, we don't have that video available anymore. We kind of pulled it down. It goes too theory crafty, and it just really wasn't, you know, something we had in the curriculum. But we should make a summary video talking about what the risk interval actually is. It's a pretty cool thing. The Catalyst one should have it. Okay. Yeah, I'm just taking notes of, we have this thing, we're trying to do this auto refresh just to make sure, like right now, you see how the letters popped up, but the drawings didn't pop up. Okay, and I'm gonna hit refresh and everything pops up, right? No, it didn't. Oh, wait, actually. On with the display. Oh, with the display. Look at this. John, check this out. If I did this, I just turned redistribution zone on and off, and then all the walls popped up. Everything popped. So nothing popped up on its own. It was the display toggle. That's probably what it is. So no RDZ, no walls, no hedge pressures. Showed up just the letters. When I checked, I unchecked RDZ, checked it again, all things pop up. I'm on edge. Okay. All right. Yeah, you didn't hit refresh. Everything should up. It's an issue with Edge. We think it's with the browser. I just had to toggle something on and off. So if I switch tickers, it does the same thing, right? I found this out yesterday. It was like, so we're troubleshooting like browser specific things. I'm just trying to recreate the issue. Okay. BLU and QQQ, we're pretty good supporting here. Looking nice. Resilience is negative. Let's see, SPY. Yeah. So I'm going to kind of wait. Let the market do its thing. Resilience being negative, right? We're going to sit on this one for a little bit. No clue what's going on here. BLU off a hedge pressure. Yeah, probably. Let me let that get there. I'm going to take a quick bathroom break and I'll be right back. I'm going to hang tight for just a little bit. I might take a scalp off at 398 to trade it long. We'll see. Hold on. Just to trade it long back to half cap, but it'll be small trade. Because right here, resilience is negative, so this is resistance. There could be a little scalp off of that, but that's it. All right, I'm back. I'm on the phone with my doctor here, trying to schedule an appointment. Okay, the answers to my questions. What's up, you guys? Do you have any questions? Y'all have anything for me? Okay, that's fine. All right. Well, that's the trade I was thinking about. All right, let's take a look at some things. Let's do some runs on here. Do the thing with the scanner, take it up. All right. Do you understand my position sizing trick? That position sizing trick is awesome. I love it. So this is what I am seeing. And refresh walls. 1 second. Hello? All right, so you guys, that pretty cool position trick, right? My position sizing trick, it's a pretty cool trick. Figure out what's going on here. Let's take a look at this. Let's do QQQ bands really quick. I'm just gonna sit here and chill. A lot of times it just on FOMC day, if I don't find a quick scalp, that would have been the quick scalp. I really just kind of, analyze, and we're gonna talk about what we think. We're gonna theorize what we think's going on with the FOMC. I'm usually pretty good at this. I'm going to teach you guys some fundamentals. This is kind of boring today, but we'll find some plays. Normally, the trick when trading FOMC is to not trade leading up into the event. You get a quick scalp, get in, get out. That was probably it. That BLU bounced to hedge. To half gap. Get in, get out, call it a day. Through 773. So we're going to get our DD bands kind of front and center. Let's just kind of assess what we do see, right? Let's double check Microsoft is here. Let's see if we got... Ooh, baby, they fixed Microsoft. Wait. No, sorry, Meta. Hold on. Did they fix Meta? Does it look better? They said they looked at it. Getting better. They have an issue with the old Meta ticker. We talked about this one. Well, Yeah, I love to trade the FOMC. Even though it's random, I'm really good at it. I promise you that. The FOMC, you have to be good at it. You have to know you have to get in, get out. I touch what I want, and we're going to talk about what I want. I'm going to plan a trade, but I'm going to get a couple steps ahead of the Fed. I'm in the camp that we're going to end up with, there's a very possible pathway of having no rate hike change. Very possible. And I know it's not the popular opinion because everybody looks at the swaps. I get the swaps, but the trade comes from seeing something people don't see. All right. I will demonstrate. Okay, I'm going to talk to Jod for a second. Yeah, the MHPs are always correct. They should be good. Gonna make this interesting, Matt. Let's go, Brian. You got a wager for me? Okay, I'm Jod. Now you can see what I'm doing. Watch, I'm gonna switch a ticker. I'm gonna go to QQQ. And I might just need to clear my cookies and my local storage, but look at this. Letters showed up, and this is this morning. The liquidity map, letters showed up, and nothing shows up. If I click redistribution zone off and turn it off, everything pops up. There's some kind of block that's coming with these. If I switch to SPY, right? It keeps doing the same thing. It's gone. If I uncheck anything, the rest of the drawings that were there show up. And then I click it, it comes back on. So when I switch tickers, it's been like this for like 2 days since the last patch. So are the mini charts updating? They are not as well. The smaller charts are also not updating. Let me show you really quick. Everybody say hello. Amjad is watching the stream. Amjad is our head development. He's the one making all of your dreams possible. You better give that guy a pat on the back. I'm gonna tell you, Amjad, A-M-J-O-D. So A-M-J-O-D, A-J-O-D. This is the man with the plan. He's helping us out. I'll tell you. He's in the hospital working on Rocket Scooter from the hospital bed. Okay, this is what I'm talking about. This guy made Rocket Scooter possible. Okay, let's go. All right. See right here, buddy. Okay, look. If I just add another, these are the child charts. So these are actually there's full instance pop outs, right? So I popped out the instance and then I just lowered everything down. So this is, we don't have just pop outs of charts. This is a whole 4 different instances, right? So I'm putting something just random right here. See right here, the letters pop out. He's troubleshooting something we're experiencing on Edge, and this is just for me. So you'll see nothing updates. I'll toggle some stuff, and all I have to do is uncheck something. And oh, actually this one's behaving slightly differently. So let me refresh. Let's see what that does. So that's there. I switched to Amazon, no letters. Okay, now they pop up. So let me do this really quick. So it looks like switching to QQQ, nothing showed up. I'm just unchecking and checking, nothing showed up. Hit refresh, nothing showed up. Hit F5, everything showed up. So if I switch around to back to SPY, the letters are gone. The letters are there and the drawings are gone. And this now becomes like the main window where I uncheck and check, they pop back up. Yeah. Maybe the socket hasn't connected. Yeah. And well, that's the thing. I am hitting refresh. I did log everything out and log back in. So I logged out and then I re-popped out new instances. So yeah, I would presume the socket's not connected. But even though I'm hitting refresh, stuck at waiting. Market connected. It is connected. It's stuck. And then it pops up. So something, and the interesting thing is I opened these charts to test this out. I'm just talking to him really quick. After I reloaded the main platform, I closed everything and reloaded the main platform, logged in, refreshed the token, and then I arranged these windows. This wasn't load layout. This is popping out 4 unique windows. So yeah, this one it's still waiting. So that would be one of the things that's probably causing it. But either so, it looks like the main window was disconnecting. So, just like so. And it did this yesterday after market. I was doing it as well. Amjad changing lives. He really is, man. He really is. Rocket Scooter has been like my brainchild for the longest time, but Amjad and his team are just phenomenal. These guys, we owe a lot to them. You got to put up with me all the time. That's difficult. Either here, in any case, the interesting part is when I toggle, it pulls back up. So that part I can't recreate. But I think if I could be some kind of hiccup in the local storage, so I don't know. All right, let's talk about Res positive. Yeah, res very positive. We're close to hedge pressure. Let's see what we have. Now remember, we're in the middle of the DD area. I do kind of like what I see, actually. I did want a long near hedge pressure. Let's keep an eyeball on resilience, right? This is not irrational. It's pretty good. I do like what I see, actually. Where would I trade to? Let's go ahead and do like an R&R calc, right? Let's go ahead and do opposing walls. So we're going to do the inputs here. Let's go ahead and spy. Let's look at monthly. Let's see if there's any resistances around 400, give or take. There are not. Let's do a single date input for Friday. See if we have any opposing walls here. Nothing for the next week. 385, nothing there either. Oh, wow, okay. Let's see what I can do. Yeah, res is very positive here. Let's take a look at QQQ and see what the limitations there are. Q. This is going to get slightly... so yeah, upper DD band. I mean, that's a pretty sizable trade. There's really nothing in the way here. Let's double check QQQ opposing walls. This is a trick I'm looking for any put walls on weeklies going on Qs. Should I just do something small? Yeah, let's just do something small. It's type 2 res on Q. Oh, actually, the S&P is the weaker of the two, and they're all bullish, and that's one likely to go. So 83, we're supporting bull zone. Yeah, this is really good. Now, interestingly enough, I need to trim this position before FOMC, right? Y'all know how this works. I need to get into something, but man, this is going to be really hard to gauge because it's unlikely to fill that before FOMC. It's likely to do something during FOMC, and we're right in the middle. I don't have a decent upper target, so I kind of have to wing this one, right? I'm going to make 10 points or lose 10 points. How about that? I don't think we're going to run 30 points before FOMC. So let's talk about what I think is going to happen in FOMC. I think we're going to get some shock news. I think the market's going to move somewhere. And with DD being 0.83, I think we're going to stay in the bull zone, which means we have a pretty decent idea of where support can be. Now, if they come out at 25 basis point, that's expected. If it comes out at 0, the market's probably going to rally really quick and then sell off. There's probably not a lot to take from. Oh, did I get 2 on accident? I thought I was going to get 1. That's okay. Just seeing what we get on this one. Again, just to have something on the table. Resilience is positive. It's a BLU. I should have longed right here, but I was trying to reschedule a doctor's appointment. We good. Yeah. So I'm John. I have a lot of cool things planned for you guys. You have no idea how cool it's going to be once everything comes out. Rule assist mode comes out. Programmable alerts come out. I mean, it's super good. Super good. Okay, let's do some ideas here. Venmo. So give me 1 second. I'll have a little coaching session for you guys. Y'all gonna love this. Don't go anywhere. Hang tight. Suspicious login alert on your Venmo account. Ooh. I wonder who wants to hop in and use Venmo to like pay the valet and stuff. Playing some new every day. What are the green lines, Josh Kim? This is it's called DD bands. So this has to do with this is a futures thing. I put these bands on my chart. it is a sign of rational market. So these are range bound areas that I would trade with. That I'm going to trade to. So I'll walk you through that in just a little bit. BLU, here's the thing with resilience being negative. What I'd like to see is the market dip to somewhere so I can long back into something. Now, again, bull zone is very low. There could be an irrational break today from FOMC down to the downside that supports a bull zone. So remember, anything that I'm bag holding or holding upside down has a very tremendous amount of fall potential on a hedge break. 394 is about a 40-point dip. It'd be rare to see the market move rapidly on the onset of Fed. The S&P is negative, which resists right there. So being positive is what I wanted to see. So this is one of those things where, okay, resilience might about to shake me out, right? I'm just getting a little small position. Everything's nice and positive. Let's analyze QQQ really quick. So I'm kind of at the upper end of the limit. I need resilience to go positive or this is a loss. But in all honesty, I'm going to give it a minute or so just to play out and then see what's going on there. Everybody smash that like button real quick. Let's give that algo some love. How am I playing FOMC? Yeah, absolutely. So the FOMC, there's no reason to do much beforehand. I'm taking a tiny little scalp. I want to either get 10 points or lose 10 points and then just call it. The market's likely to do very little till FOMC because everyone's on the fence. Are we going to 0 or are we going to 25? I know that's the unpopular opinion of 0, but I want you guys to hear me out. Part of being a trader is to try to see things others don't see. And it's easy to guess the obvious thing, right? Everybody watches the news, everybody reads whatever, and it tells you 25 basis points, Fed fund swaps posting up 25 estimate. Everybody's reiterating, regurgitating that number, right? We said it would be 25 months ago. We knew what the schedule was going to look like, but now I'm forecasting it's very possible that we get a surprise today. I build a really substantial thesis as a trader, and I try to see something maybe that people don't see. 0 is not a pipe dream. 0 is a very responsible thing for the FOMC to do. 25 basis points is not a lot. You have to think about this. Let me turn this down a little bit. A change of 25 basis points to the actual rate is not a lot. It's not going to do anything to borrowing, to lending, cost of lending. So typically when the way that you have to think about what the federal funds rate does, does anybody know if y'all want to take a guess? I'm going to be smarty pants here. Could be. But still, I was having those memory leak issues. Yeah, I was having memory leak issues with Edge, having multiple browser windows open. So I think you have only pop out charts, not entire platform instances. This will lower mem use. So proceed with that patch. Yeah, I'm gonna talk about the trick I'm doing on FOMC. Everybody smash a like. If we get up to 100 likes in the next couple seconds, I will show you guys my trick to trading FOMC. Very cool trick. So I'm actually having memory issues on Edge. And it's funny because I have top of the line computer. A lot of my stuff is top of the line. I've got 32 gig DDR5 Dominator Platinum. Best RAM on the planet. Literally the best RAM you can buy right now. I've got... It is amazing how good this RAM is, and it's still with that. I was getting we can't load memory. Of course, I've got a lot of things open on the computer. I've got 2 computers running my stream, so I mean, I'm not using way too much. I should be having RAM issues, but there's certainly memory leaks or something and what we're doing is when you open up multiple versions of the platform, it's full instances. So what we're gonna do is pop out just the widgets to kind of save on that. Edge stealing all that RAM. I know. But I run the AMD Magic Boy. I'm an Intel fanboy, and I know that's the least popular thing these days. I was an AMD fanboy when everybody was Intel in my late teens. And then I switched to Intel when I got serious into building computers and overclocking. Intel boards had the best controllability of a thing called vDroop. So back in the day, before overclocking was such an easy thing you could do in software, You had to overclock by removing chips from the board or getting a number 3 pencil and shading resistors to physically change the resistance. So I used to like manually overclock my boards by fucking with the board. That's like old schooler. So I'm one of the OG overclockers. I used to build water cooling systems before you can buy it from the store. I'd go to Ace Hardware and be buying like tubes and pipes and valves. And I would ask for such weird custom things that they would give me weird looks like, what is this guy actually building with these things? I'm like, hey, do you have a little tiny canister that I can put some wires in? They're like, wait, what are you building? I'm like, oh, a cooling system for a computer. They're like, sure. So the funny thing was I would use fish tank pumps, right? And I would use like PVC tubing and stuff before you can buy water cooling kits. I can get radiators like from junkyards and old mini fridges and stuff. I push the lotion on its skin. So I'm an old school overclocker. I love building computers. This is my favorite thing to do. The computer I built took me 2 years to get out of the parts. I actually posted a picture on Twitter. So it was fun. It was a fun build. And let me get to some of y'all's questions to talk about. I know y'all want to hear all about computers right now, but I do like to brag. I'm not the kind of person that wastes money on a lot of stuff. I have a kick-ass car, I have a kick-ass house, and I have a kick-ass computer. And everything else is like eyelash money for my girlfriend. Other than that, I don't spend a lot of money on stuff. That's the secret to being wealthy. Don't waste money on shit. Okay, so this is my computer. Right here, this is all of that. I built this whole thing myself, built all the tubes myself. I got this really cool translucent reflective coolant that reflects lights, and I have these special LEDs in here with diffusers on them that diffuse the light like this to make it look cool. So I have that in both of these places. Then I have two 3080 Ti's. I have custom cable wraps that I put on all these cables. This is the streaming computer right here. This is a whole CPU and some RAM and a capture card. This is my main computer, does all my stuff. So this sends a signal out, catches it there. This renders and sends out the stream. This is just a streaming computer right here, and this is a main computer. So there's you see two different water blocks. Really cool distro plate to kind of make it nice and clean and tidy. And don't laugh at this. This one looks a little wonky. I fucked this one up, and then I was just so exhausted bending tubes that I decided just to leave it. This one's pinched a little. But I'm usually pretty good at bending tubes, but there are some really complicated. Bending tubes is hard. If you ever built a computer, it's really hard to measure and bend and get it right. This is a difficult thing to do. So, that Gamma guy hating. Oh, dude, no, I love these people. Always troll me. They're so funny. These are all friends. Everybody talks shit. I love it. I was like, wow, where were you in 2020 when I can save some money? And then fucking KC comes in here. Mine's coming along nicely with showing up his, 1996 Packard Bell, and I'm like, no floppy drive, what an amateur. Everybody's so fun. Kenneth, if that's your computer, dude, that's sick. I like how clean that looks, man. That is really sexy. It's very sexy, and I love those cables right here. Is that what are they called? There's a brand called, I think it's Asia Horse is the brand. Those look like Asia Horse cables. Asia Horse. Very, 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 very clean. I love the white with the black, the combs. All right, super cool, sexy computer. I love that. I love like all white on the inside of a computer. I just left this on rainbow when I took the picture, but it's got a cool color theme now. My whole office looks like a sunrise. It's like orange and purple and like light blue. Kind of reminds me of the outside. Anyways, okay. Long story short, let's get back to what we were talking about, Fed and everything. If you ever hit that like button, get up to 100, I'll tell you my story on how to trade the Fed. That screams Stormtrooper. Oh yeah. 2 CPUs in one case. Well, 2 motherboards in one case. Yeah. So it's a special computer, and it actually comes with a special power supply that Fantex makes. And the power supply has, I'll show you really quick. So like, you know, you have your different. Let me get to try to find it really quick. It's called the Fantex Revolt, I think is what it's called. Okay, I know you guys don't want to see computer stuff, but I need to get 100 likes and I'm telling you my story. Everybody hit that like button. The Revolt X, it's 1,000 watts, I believe. Yeah, or 1,200 watts if you want. I think at the 1,200. Who's messaging me today? It has, you can connect, it's got, you see right here? There's two 24-pin ATX connectors right here. So it powers two different motherboards. Right? These are your CPU 12 volt. Is your ATX, and then these are all your 12 volt rails for all your EVGA and your VGA stuff. And so you can do two motherboards. It powers two at once. Pretty cool. Now it's a lot of cables. It took me like 2 days to get the cables in the back of my computer. I'm not gonna lie. There's so many cables. Having two computers in one box, cable management. I literally jacked at my hands having to pull that cable so tight in that box. And I was scared to move it, like it's all gonna fall apart. Will you ever front an HP when looking to trade against them? Do you always wait for the level to be touched? Yeah, I always wait for the level to be touched. I just missed it because I was having a doctor's appointment today. So I wait for the level to be touched and then I long at the level. Well, I don't understand what you mean by front run. Like that's my level. So if it falls to my level, I'll long at my level. So I got in late just because, and again, I don't like that resiliences are falling. I probably should start clicking. Okay, you ready to talk about Fed? Okay, everybody, click that like button. Let's go. I'm going to teach a little webinar, little small one, about how to play the Fed. This is something you don't want to miss. Okay, it's very important. There's a trick, a bunch of tricks. I'm doing this for a while. Ton of tricks. You can make a little tweet blast about it. Okay. Okay. This is gonna be worth. Okay. All right, let's go. One of the major tricks understanding the Fed is what you have to first and foremost build a thesis on what you think is going to happen. To understand that your real trade is going to come in at the time. And I'm going to teach a webinar and record this for our class series. All right. So the first thing you have to do is understand what you think Wall Street thinks is going to happen with the FOMC. Okay. So you can do... Let me see if I can find... So let's go to, let me open up one of my things I normally have. Let's just go here. Normally they'll have some things about it where the fund features are. Traders expect 25 basis point Fed hike. Beyond that, the view is cloudy. Yada, yada, yada. You can look at, there are things you can watch that have like a kind of a rate anticipation. You can come in here and see investing.com has a cool one. It's based on the Fed futures prices. There's FOMC futures. You can see that. But if you don't want to go see what the actual futures are trading and convert it yourself, they have it right here. There is a probability of the target rate being this. And this is the probability of the target rate, stop doing that, being that. It's about a previous week possibility is about a 50-50. Right now it's leaning on about a 85 to 15% probability to go to the target rate of 75 to 5 or 450 to 475. Here's what I think though, okay? Currently right now you can see that we're at 475. So there's a 15% chance of zero. It looks like futures have priced in a lower probability of that as we've approached the actual day itself. So understanding what Wall Street is perceiving is one thing. So that's the first and foremost. You have to understand what Wall Street's wanting to see. Wall Street's wanting to see a rate hike that still needs to go. Now, why? And you have to say is like, why are rate hikes a thing and why are we dealing with it? And you have to build a thesis. You have to understand what would shock the market right now. So we see that people are betting on 50-50 and now it's betting on 25 basis point and that's what's being priced in. Then what you do is you go back in time and you see what we've been doing over the last week. Okay. An expectation, the market has reverted to mean, but it's actually been, a couple of bullish weeks on that, on trading. And so when we're moving up on an expected event, right, as the market is becoming more probabilistically pricing in a rate hike, why are we rallying? Well, there might be some opportunistic folks that believe that we might actually be hitting that zero, and maybe they're covering shorts, or maybe they're just covering shorts to get out of the way to begin with. Either case, the market's been reverting to a middle going into this meeting, which always tells me expectations are going to be met. Anytime you go to the middle of something, the market's preparing, or expectations are pricing in. So anytime you move to the middle of a range, the market is pricing in the anticipation of being able to move and contain the blast without breaking out too high or too low. If we were crashing in the FOMC, that's additional volatility that would continue to make the market more turbulent. So when volatility has been collapsing and you're kind of trading towards the middle of a range, you know that the expectations are pricing in. The market's pricing in that higher probability thing. So right here is the value of the stock market at a 25 basis point hike. If we get a 25 basis point hike, you can understand that the market is likely going to not respond to the rate hike. It's going to respond to the press conference because the rate hike is pretty much already priced in and people already guessed what it is. So expectations are going to come out. The market's going to likely do nothing if it's 25 points because it's already priced it in right now. It's called the efficient market hypothesis. The next thing is that if zero comes out, that's the kicker. That would be the shock that would get people going, or 50 or more would be a shock that gives people going. And you'll never, and this is a trick, you want to write this down. Everybody grab a pen and paper real quick. I'm going to give you 1 minute to grab a pen and paper because I'm going to teach you. I've traded enough of these FOMCs and you're going to know. You're going to know. You're going to learn something really cool about it. Okay, ready? And you can always rewind the stream. You will never be able to guess if that was a good thing or a bad thing. Zero could be the best thing in your mind and the market can rally and then it can crash. 50 could be the worst thing in your mind and it could crash, but it can rally. It doesn't matter what you think. It matters what other people are doing. It's not people jumping in and taking a bet on the FOMC right now when that event comes out. It's people that have been trading for the last weeks to months since the last event taking profits on their trade. People that longed the last time, or people that shorted the last time, or that are in longs and shorts over longer periods of time may see, ooh, zero base. Like, I'm tired of being, like, somebody might have been long the market and they're upside down and they're ready to get out. And they're like, ooh, you know what? If we get a zero and that market rips, that's where we're going to dump all of our positions. They dump into it and then it turns around and releases. It is 100% random how people decide to behave after that news comes out. Typically, the news is always guessed, and as a trader, you should always be able to guess very accurately what the FOMC is going to be if you understand how they work and what they're trying to accomplish. I'll talk about that in a second. Res is way negative now, which just means half gap is resistance. Hedge pressure is support. Half gap is resistance. So right, this is not the best sign for a trade, but all resilience is negative is meaning that we are resisting here to somewhere. And bull long up is like we're supporting there to somewhere. I've got to stop if we start losing hedge pressure. I'm out. Right. So continuing what I'm saying, does everybody understand? Give me a big old fat yes in chat if you get it so far. And feel free to like and share and retweet the tweet so we can give a little session on how to trade the Fed. So you have to go into the FOMC understanding what you're in for. If whatever the price is the moment the news comes out, another trick, you have to understand if the market, stock market is always getting ahead of the news. And if the price is right here and the news event comes out and it dips and then comes right back to where it started, it's called a non-event. And we teach this in our Catalyst class. The stock market accurately priced in the FOMC. It just got volatile and volatility dried up. If you ever return to the price it was before the event, it's no longer an event. The move from there is random. The move from there has nothing to do with the event at that point. If the FOMC raises rates 100 points and the market does this and comes back, from this moment forward, whatever happens, you cannot say it's because of the FOMC rate hike, rate change. If you ever, and this comes with any catalyst, CPI, dips, comes back to where it started, the market effectively priced it in before it happened because the market maker lowered price on the shock and buyers were found and came back where it was. The market was liquid before the event. It neutralizes itself, returning to the same price. If an event neutralizes itself, it becomes a non-event. No longer do you use it in your decision making. As a non-event, it completely removes itself from consideration. The market is now immediately from non-event pricing in the next thing, because the market is always trying to get ahead of the news because people are always trading to bet on the event and bet on the outcome before it happens. Traders aren't jumping in, getting into positions when the event happens. Quantitative analysis is so strong these days. People are so accurate at predicting the outcome of most of the events. People can estimate what the CPI is going to be by having a quant group analyze market conditions and figure out what the inflation rate is. And they say, oh, it's going down. We calculated it before the news comes out. Sophisticated trading groups these days know the answer before it comes out because they can calculate it too, the same way the Fed calculates it, right? So Wall Street is always pricing stuff in. So if you return to where you start after an event, it's called a non-event. It no longer is pricing in. It effectively was priced in, and now we're immediately moving to the next event. Do we all got that? So if the Fed dips and rips and comes right back to where it started and then starts selling off, you can't say it's selling off because of the rate hike. It's selling off because of something in the future that people are looking at now, the next event that hasn't happened. Market's always pricing in the next thing at all times. Now, if we understand that, right? Market's always one step ahead of the news because you always have, at best, insider traders know the answer and they longed into the thing, which drives the price up, right? It's called the efficient market hypothesis. All news or effective rumors or possible news are always theoretically priced in because somebody's acted upon it. Somebody knows faster than someone else, and that's etc. Keeps going. So if the market collapses and doesn't return to the price, it means it wasn't priced in. The expectations were higher than actual. This kind of event, and if you break one risk interval to the low side, it's called a catalyst. When that happens, the market underestimated the impact and somebody was shocked. And somebody changed their mind. I don't like this news. 100% return or 50% on what's your return on what? It's 50-50, we don't know. Yeah, so if it's a non-event, it's just back to normal trading. You no longer consider it. And non-events just completely, like in a catalyst world, non-events are like they didn't even happen. And you just resume your normal trading day, your normal liquidity maps or whatever. But you have to think of the next thing. So after the event happens, the real thing typically is the press conference, where he's hinting at the next event. So the press conference is where the real move happens. Anytime you return to the event at any point in time. Any point in time. So if it does this and it collapses for a day, collapses for another day, and then rallies for a day, and then rallies back to there 3 days later, then all of these days are still behaving off of the, oh, there we go. I just want to get a little profit before the stock market hit Fed. Let's close that out. I just want to get a little trade. Let's close that out. $700 on the 20K account. There we go. I just want to get like 10 points, call it a day. I'm going to sit out till FOMC and make a bigger trade. So my 100K challenge account, it's starting at 10K. Just showing you guys, it's on another screen. Save some screen real estate. Is here. So 10K is now at 20,869. This is the 100K challenge that I was doing before I started showing off the harder challenge, the ETF stuff. And so, yeah, just a little spike. I want to get a little trade, 10 points, call it a day. And I really just going to be flat going into Fed. But if you continue to sell off and you return to the price at another day, then the effect of multi-day maybe squeezing or margin calls or whatever caused by that event is now over and the event's over. So I keep on my charts like a series of all the events that are still active. Let me show you up here on my screen. On the S&P, I have this really awesome chart right here that I do, and I keep history of pretty much all the events. It's going to look a little messy because this is my master chart. I don't trade with this thing, but I always reference it. Here was an event called Powell Testimony. Powell Testimony dropped the risk interval and became a catalyst that day. The catalyst became an event, right? Remember, if you kill out the catalyst, line becomes an event, but it continued to price in. Powell's testimony shocked the market. As you see, we have never returned to that anchor point from when the testimony happened. Does everybody see that? Yes? I mark it with the gray line. This is the moment of an event, and today we'll have the same thing. If we ever return to this price, then whatever Powell said is effectively priced in now, or underpriced, right? But if it's still trading lower, then Powell's testimony is still impacting the market, whatever he was talking about. And so anytime you see a gray line and a red line, there's an event that's pressing the market. And as you see today, that anchor point is always a pivot weeks later. So upside targets today could hit this area to close off. Powell said something, and what if the FOMC comes out and it undoes what he says? Boom. You return to equilibrium. Market makers balanced out that deficit they took. People shorted to them. They bought. They raised price. They dumped their position. We're back to neutral. Do we all see this? So now I have an upside target today. When catalysts are on the horizon, or possible events are on the horizon, I always try to look for event lines, which are these gray lines on my chart. And you can see, and I know I kind of leave history of them, but anytime they touch, I get rid of them. CPIs, PPIs, you name it. I always keep all my events, and I keep them in one place, and all my yellow lines and red lines in one place for history. Where do you come from? You're from a class. So this is an older one. Can I just delete these? Let's see, hit. It's actually from a class. Okay. So that's all. So now I know that we have, and if you have anything, you can always mark them and always keep track of them, right? These are old as well. And I'm going to teach you guys when this happens. I'm going to walk you through it and show you how I draw them. Is that one still active? Yeah, that one is way still active here. Okay. All right. So we need to develop a thesis, number one, before the release comes out. What do we think it's going to be and why? So we'll dive in that in a second. And we have to talk about how to trade it. So when the actual release comes out, the market's going to move. And all I'm looking to see is if the market moves and returns to the same price. If that happens, then check. Now I'm immediately focusing on the press conference. It's like a 30-minute pump fake that happens in 3 stages. The first 5 minutes is the knee-jerk reaction. If there is a change that's drastic, that shocks everybody, the knee-jerk reaction will dictate and change the market drastically. If the event happens and you move more than one risk interval, which is currently what, 31 points on the S&P, then you have a problem. So let's put some time frames on here. Okay. First and foremost, you need to always, I like to use investing.com. It's my calendar front and center. You always got to know what's going on the calendar. Make sure there's nothing else that you have to consider. So it's about FOMC day. Interest rate decisions, 1300. Nothing else coming through. So at 1300, you're going to have a release. Okay. Financial juice, I keep that open because that usually gives me a pretty quick answer. I look to see if the market does one of two things. If it goes at least one risk interval, which is going to be 31 points from the moment it happens on ES. Up or down. Everybody got that? Class, tell me what happens at 31 points. If you don't know, the risk intervals changed on the S&P. It's very rare. You must go update your DD bands, everybody, with the new numbers. Give me a guess. Irrational, it's a catalyst, right? So I either check to see, A, is it a catalyst, which is below, warning sign, or above, or if it comes in shy and returns back to where it started. So point one is we either go a catalyst, and what do I do when there's a catalyst? Everybody? Catalyst is active, what do I do? What will I do? Catalyst event and Lee nailing it, right? You've been through the courses, the extended trial, you nailed it. 100%. What am I gonna do? I'm gonna sit out. I'm gonna be done. I'm just gonna talk about the market. And if you guys want to go through the most substantial trading course series you've ever put together, $199 a month is very inexpensive. Oh wait, hold on, we're having an extended trial. $35 for 3 months. Ashton is teaching literally the most substantial options courses I've ever seen. This is amazing. He's adding them to the mix. $35 a month for 3 months. We have a special surprise for you guys this week, so sign up. You can get the full version of Rocket Scooter, all your data feeds unlocked, the full access to the courses, everything that we teach, and our community. We just passed 4,500 people. It's amazing. We're at 2,500 3 months ago. So $35 a month, literally for 3 months. You guys will never find anything better here. I promise. It's normally $199 a month. There it is. There it is. There it is. There's the PAL. Watch this. The red line. Watch this, guys. As I was saying it earlier. Watch it. Watch it. Watch it. Keep your IRLs on your charts. You got... This is... Isn't that crazy? Look at that. Look at that. Predictable high volume pivot sitting there for a month. I mean, hello, Rocket Scooter, right? You see that? Literally the thing I just said. Josh, are you in the program? Are you in our extended trial program? Okay. If you go to the exit targets section 3, IRL is a technique that is described and how to do it in there. Okay. See that? Literally, markets like to trade from event to event. So whatever Powell said is being proven by the market now. So what originally shocked, something has changed along the way to have the market return to where it started. What's changed along the way? Well, the expectations, right? You had 85% chance of or 50% chance of 25, about 50% chance of 0 on Fed futures last week. Now it's about 85-15 chance of 25 versus 0. The market effectively changing direction as of recent news events have caused, likely as inflation is starting to run rampant, people are starting to bet that the FOMC is going to continue to raise rates. However, we're going to make a judgment call here. As you see, Powell's originally in his testimony was saying something along the lines that was going to make you think the market was going to be worse than it is. So people are getting out of the way of a short and moving up, which means the market's likely pricing in something that's going to beat expectations. Again, likely hinting at 0. But let's go ahead and go forward. All we did was close out that red line, which kills the yellow line as well. So you guys have to learn that from the techniques. Okay, so back to at 1300, right? Or when the news happens, if I hit a catalyst, I'm closed for the day. If it goes 31 points in either direction, I'm done for the day. Trust me on that. That's just the rule. We teach you why in the catalyst class, though. Everybody here, you got to type, quick question. What happens when there's a catalyst active? What happens when you go 31 points or more on an event? Let me show you what a catalyst looks like. I take one of two paths. If it doesn't break 31 and goes back to where it started, then I immediately start looking forward, and the press conference is it. The next 20 minutes or so is a second shuffling to become slightly more volatile, and then at 1330 is when the market really gets crazy. So in the event, and I'll show you what a catalyst looks like in a second. 05. This is what I'll call stage 1. Stage 2, 1305. Little head fake, pump fake. It's Hakeem Olajuwon spinning around. They finally shoots the ball here. 1330. Powell starts talking about the future. There's a little quiet zone inside of here. But basically the market just does something. It either becomes a catalyst or it prices itself in. Usually one of two things happens. It doesn't just move and stay still. If it moves, it's usually a catalyst. There's very rarely an in-between. It either is a non-event or a catalyst right out the door. Pretty much the only two options. I rarely see it not go extremes. It's either a non-event, write this down most of the time. Non-event, which means return to start. Which means I'm back to trading. 2 or a catalyst. So 31 points as of now. So just mind you, when risk intervals get higher, it's because volatility is expected to be higher. They changed the margin requirements a week before the FOMC. The CME raised the performance bond minimums on these futures contracts. So they went up a little bit because there's expected volatility. So the market's expected to be more volatile. Keep that in mind. A catalyst, then I'm sit out for the day. I'm done. If it's a non-event, then I start looking at the second range, which the market tends to pre-position what they think Powell's going to say. And then when Powell starts talking, that's when the market gets crazy. It either goes one direction, no direction, or chops around as people try to shuffle around and bet for the future. Immediately start thinking about a month from now. So the real FOMC move is exactly at 1330. The moment that press conference starts, it's seconds later that the market's moving, I promise. You either need to be listening to the press conference, which is likely to be delayed. You're going to have a hard time having a real-time news feed that's going to get you right on par. But here's what I do. I use Financial Juice. It's retail level, so it's not going to be real-time. Nothing's going to be real-time. You have Bloomberg terminal or something, you'll probably get real-time as fast as you can get it. But in reality, Financial Juice is a news parser that has algorithmic capabilities, and I love this. They don't pay me to say this. I love these guys. They're great. It's a news parser. You can select whatever news sources you want, and it just feeds you the news as they release it through their RSS feeds or however they get it. And you can localize all your news in one feed. And also, their algorithm scores major headlines and makes them red. Anything that Powell says that's impactful will be red. So just watch the red text as it scrolls. It's great. So I'm going to pay attention to that. And it's going to just tell me what Powell's saying. I'm going to look for things that disagree with my thesis to understand what direction I think is going to happen. Okay, so now here's how you trade it. You ready? First of all, if it's a non-event, check. Number two is I'm going to trade the press conference. How? Well, I need to understand the limitations of the trading day like there wasn't an event. So you got to write this down. Like there wasn't an event. The limitations of the trading day are just my normal indications. Are we rational? Everybody. Type. Clean. Nice and rational. So that's good. Is DD a certain thing? Okay, so what does that tell me? Well, support here. Right? So support down here is what's expected. Breaking support clearly would be something unusual, right? Okay. Resilience is going to be, as long as it's not a catalyst or we have an irrational flag, which would be, right, breaking hedge pressure or catalyst or something, resilience will likely be leading. So I have the anticipation that, you know, we're inside of DD bands, which is great. Res greater than 0. I'm just going to make a trade plan pretending that the event isn't there. Res less than 0. Hedge pressure. So I always draw my lines to the next resistance, okay? There's a nice long trade towards the upper DD band. So hedge pressure break, which is the rare event, is irrational. And hedge pressure break can be very devastating to the DD band, become irrational a second time, and fall to support and hold. This would be the worst case scenario today. Let me calculate how far that is to you. That's roughly about a 50-point span. So we will likely have a possibility to become a catalyst in the press conference, even hitting support. This is a very dangerous trading day. Very dangerous. 50-point drop to hit the only support on a hedge break will be very terrifying, because from here it can do that, and we've seen that happen before. So what I have to understand is that I have a possible 50-point swing to the downside. If I wanted to long, the BLU has a open, long, open type setup, which you already see right there. And if res goes positive, like we said, it can break up to there. That's a pretty decent trade with a 10-point stop, right? To long off hedge pressure on a dip, or to long off a bull zone. These are the only pivots I can see that are worth longing, because all the things are bullish today. I don't see evidence of any kind of resistance to short from. I checked my walls. There are no resistances up here. So all I'm going to be doing is looking for long scalps or long entries off of my resistances, hoping that we don't have a catalyst and that the news press conference starts to push to certain levels that I can get scalps off of. I'm going to get in and get it out as fast as I can. IV is one advantage futures has over options unless you're a seller. Well, yeah, you don't get that. Yeah. Selling options in the FOMC is great. So here's an example. Obviously, if I expect DD to tell me support is here, wouldn't it behoove you that selling puts in the area down here, not a terrible idea. Like if the market collapses down here, I could sell puts betting the support happens, they expire worthless. Like basically, I don't expect that support to break with the 0.83 DDs, very long and strong. But then again, I would trade like where markets likely won't go. That's a great way to sell options. I would never long options in the FOMC. That's another trick. Never buy options to long calls and puts to walk into that meeting. Never buy options going into an earnings report. Never buy options going to anything where volatility is possibly going higher. You guys understand how IV works. It's going to artificially inflate your premium, and you're going to pay more for puts and calls because of put call parity. They're all going to go up roughly equal based on IV, and because of that, you're going to pay more for your options. And even if the price goes nowhere or doesn't beat the expected range, that IV collapses no matter if you were right on the trade. Imagine that you pay a little bit more for the, and Ashton's better at teaching this than me. I'm not certainly like the world's greatest options person. I can explain it pretty easily. Is that if the expected range is here to here and you bought a call that goes here and it just kind of like slowly drifts up and slightly goes in the money. You maybe think you're making money on the delta, but you actually might have effectively lost premium on that immediate IV crush, even though you made some on the delta. Overall, you could be losing money based on where you bought it, even if it does go in the money because of IV collapse, IV crush, right? So you have to be careful buying artificially high options into an event, because if you don't break the expected range, the IV crushes on you. Everybody understands that, right? It has to move a far enough distance to beat or exceed the expected volatility. That's just how options work. So longing options into a volatile event is a terrible idea, and a very amateur mistake that a lot of traders do, because they're so used to longing on big swings. But when traders start to get slightly more intermediate level, they start to understand that you want to have a non-directional options trade. You want to trade things like spreads, butterflies, iron condor, something like that, where you get rewarded if options also don't do something, where you want to have a leg that's on the sell side so that you can gain some IV crush against the IV crush that you lose, which neutralizes that effect. If, for instance, if I bought a put at 390.97, if hedge pressure broke, but I sold puts down here at 393 or lower, right? Buy expensive puts, sell cheap puts, or I sell cheap puts and buy expensive puts with them. One of those is a debit, one of those is a credit spread. Then the IV works in both directions. Do y'all see that? My long side options are going to lose premium. My short side options are going to gain the premium on the crush. So while one's further out of the money than the other, the crush will be slightly different. But in either way, you structure the trades where it's less impactful on you, right? So one thing about talking about the FOMC is that we have a potential 50-point drop where I can support on. And also from 398 to about 402 is about a 40-point move to the upside. There's a lot of room for a catalyst to form before I hit some major supports. So I know that I'm only going to trade extremes and off of something. My only long today is a long off a hedge pressure to upper D, because I know I'm going to get a pretty big range. There is no short setup. So if we break through hedge pressure and continues to fall, I'm just going to sit out. With everything being slightly long at the open, hedge pressure break would just be irrational, and I would just sit out on this case. So I'm going to have two options. I'm either going to long off a hedge to go up, or I'm going to long at any point that resilience goes positive, and I'm going to try to ping that upper DD band. Since it's going to be very volatile and there's 40 points and 50 points of range, I don't necessarily have to go in with the big position. I could put a couple micros on that, at most one mini. 50 points on one mini is $2,500. I don't need to go so heavy, right? I put like 5 micros on it, just gamble. So I'm going to basically look for the market to be moving. The FOMC does something. It falls. Resilience stays above 0. And I long it to bet that we break resilience and keep going. That's it. Yeah, your short win is Uncle Eric Belmont is saying expect cheap and not cheap is both the same, but your short win is effectively zeroing it. Correct. Yeah. You're effectively zeroing out your IV, depending on the balance you have of the two contracts. A lot of times if you're in a vertical debit spread, but you want to sell enough out of them, if you want to buy your puts here for whatever reason and sell your puts there, it's the opposite of what most people do. You have to sell, if you sell a lot of puts because they're harder to get into that fill because out of the money. A lot of people are gonna, like, if the market dips to here and bounces on hedge, they will sell very expensive puts right as the IV goes, like the volatility goes up, the premium goes up, and also the value of the puts go up on delta. Sell, like if it bounces at 398, I would sell 398. And as the market starts bouncing, I would immediately start buying puts at 394. That's how I would do an option spread. That's a trick on this one. So imagine anytime markets go down, puts go up, right? So market falls there, value of puts go up. So that's the moment I want to sell. I'm going to sell in that leg to bet that hedge pressure at least bounces a little bit. And once it goes up, puts become cheaper. going to buy puts outside of the bull zone because I'm expecting the market to hold there. So as long as we close somewhere down in here, my sell side's going to make money and my put side not going to make anything. Well, actually, no, my put side might make something, a little bit of delta. If they don't expire today, then the sell side makes money and the put side also makes money. Yeah, I'll be on Zoom at FOMC. Maybe I'll stay on YouTube. So ideally, like I would sell a vertical credit spread right here, or sorry, buy a vertical credit spread here. Sell a put on the bounce as it goes up. Buy a put down here. So if the market holds, then I made the credit, the full credit, which is great. The market goes in here, the sold puts lose money, the long puts gain money. So it's going to be a reduced fixed loss at some point, right? If the market continues to fall, the loss is fixed. So ideally, a good structured trade is to bet where you don't think it'll go and give yourself protection in case it does go, which is here. So an options trade is possible. Again, like I said, trading options in high volatility is really hard to do because your spreads between bid and ask are really, really hard. It's really hard to leg in when markets are moving super quick on options. So with that being said, you would anticipate that right now and build it when it's not crazy, right? That's a way to trade it. So I'm either going to long off of hedge or long off of bull zone, and that's about it. Now let's talk about a thesis. Why do I think zero? Right? Why do I think zero? You have to understand the mechanics of inflation. And so there's a couple things that are very important. I'm just going to give me a little trick here. And I know y'all love hearing me talk about the job market. You have to understand what makes the Fed change rates to begin with. Okay? Who has not joined the extended trial yet? Are you guys liking it? $35 for the full rocket scooter. You're gonna, and you guys, after a little bit of time, are gonna be like a really cool discount if you stay with it. You're gonna love it. It's a once in a lifetime thing. We're never gonna do this thing again. Okay. So about things that really matter. You have to understand the mechanics of what caused inflation to begin with. And so, right, when COVID happened, everyone got laid off for a little bit. Market nuked itself. All your shipping and transportation, all these issues just became delayed. And the market hit this like logistical spaghetti bowl that became so crazy. It's taken years to untangle and still getting there. Somebody wasn't working. They go back to work. They're the only truck driver in town. And everybody needs a truck driver. Or somebody has a storage facility and you need a storage facility. They're the only one that's open. They start gouging prices because, well, supply and demand, right? So inflation just naturally came in because of shortages. And it took a while for things to untangle and come back to normal. And after those shortages kind of went away and everybody came back to work and everything, then you had an interesting effect of you had all this extra demand and very little supply. So the supply side, demand for products. I mean, I paid like triple the price for my graphics cards because there was low demand or high demand and low supply. So everyone pays more money for something when there's not a lot of stuff available. You close the world down, there's not a lot of stuff available. Prices just go up. And so the prices go up in this mechanic. The inflation is created not via hyper-economic activity, but through shortage, the other side of the coin. They call it cost-push inflation. It's inflation that's triggered by shortages on the production side of things, not shortages in demand. Again, it's not an oversupply, not anything. You have an undersupply that causes demand greater than supply of stuff. Every part of it. Raw materials. Well, miners weren't working. Food. Well, farmers weren't working. Or truck drivers weren't shipping the food. They weren't available. Manufactured goods from raw materials. Well, people weren't working at the factories, right? You had every part of it the demand started outpacing supply. We all were sitting at home. We all needed stuff. Nobody was going to work to make it. So because of that, prices go up and all parts of the production chain go up, all the way from raw material to the cost of employment. The only truck driver in town or the only farmer in town comes back to work and goes, oh yeah, you need a farmer, huh? And I'm the brave one that's roughing it. Yeah, I'm roughing it. There's a pandemic. You're going to pay me double. Oh, God. All right. Okay, I need somebody. All right, double the price, but you're the only one. Another guy comes in. Hey, man. Oh, I need another person. He wants double too. Fuck it. All right, you're in. Right, people are paying more because of supply and demand. Labor shortage, transportation shortage, storage shortage, raw material shortage. And then people came back to work. They started paying them more. The cost of everything goes up. So then everybody starts demanding more. Hey, you need a job. Yeah, I'll come take the job. But hey, man, there's inflation. I can't afford my cost of living. You got to pay me like 30-40% more. Since the price of everything went up because of the shortages. And the workforce is like, well, all right, we got to get back to business. We'll take the hit. So everybody got high salaries, right? And that's where the real problem for inflation came from is salaries. Price of stuff went up due to shortage. People needed more money to pay for it. Companies said, sure. The market's at an all-time high. We got plenty of money to spend. COVID bubble. Post-COVID bubble. Companies had so much free cash flow. Company leaders were dumping their own stock, Elon and others, right? Why? They knew it was a bubble. They knew they were going to need cash. They knew they had to cover salaries and things like that. Companies got smart, right? They understood the mechanics we were dealing with. So inflation's actually caused from the shortage of goods and materials and now in production. And now inflation's mostly caused by issues in the labor market. So when the federal funds rate changes, what it does is it makes the cost to borrow money, like you, me, or anyone else from regular banks, go up in a way. If you need to boil it down to something, them raising rates destimulates lending, which destimulates spending. Your dollar or your credit doesn't stretch as far because the interest rates are higher and all across the board, all kinds of credit and lending. And so raising rates traditionally slows down the credit market. And that hurts banks. You can't get a loan that easily. Banks make money on interest. Well, if the Fed funds rate goes up, the banks make money with the Fed. And they go, diversify, choose, deposit with the Fed, or you can lend money out to risky borrowers during a recession. Whatever the case may be, banks become tighter for the money they lend to borrowers, all kind of stuff. So eventually, it's not like a direct correlation between federal funds rate and all the other rates, but there is kind of like a generality of how banks behave in an environment of risk when rates are going up. So it's harder to borrow money. Let's just say that easily, whether it costs you more or the banks are stricter. I think they're very concerned with SVB and other possibilities. So if you think about it, why was inflation happening to begin with? And that you can easily say it, and that Wall Street is usually forecasting. And I know I wrote this huge thesis on this when I said October was the bottom of the stock market. When we were right, we made that whole thesis. There's a whole 20-page Reddit thesis I wrote on Reddit. Kind of went viral for a little bit. October, I said this is the bottom. Everyone said I was crazy. I walked away with 1,200 and 2,600% gains on my Google and Apple and JP Morgan calls. Oops. I was right. And that's how I did it. We're going to talk about this one fact. It's the job market that's causing all the inflation. And you can see it with these three things: initial jobless claims, continuing jobless claims, and jolts. This tells you the entire story. I can predict what the CPI number is going to be a month out. The Fed is chasing the inflation numbers because the interest rates are outpacing yields, the inflation rate is outpacing yields. It's not good for the treasury market, right? That's a big concern because it's how the Fed prints money. You buy fixed income assets like treasury bonds from the government, you print money to pay for it. Or if the inflation is so rampant high, the Fed won't make any money on their fixed return. So why would they lend money to the government? They need to raise rates enough to outpace the yield. So we understand this part of it. How does Fed print money? Well, they print it. Well, how do they circulate it? They buy bonds from the treasury. They add things to their balance sheet. right? During quantitative tightening, they remove things roll off the balance sheet. They don't remove them, but they mature and they don't add more things to it. So QT is when the Fed is no longer printing money, which is where we are. Why is the Fed letting things roll off the balance sheet and not buying anything more? Well, because of inflation. Why would you buy something with a fixed yield, which is fixed return, when inflation is a fixed loss? Inflation is how much your dollar loses over a period of time. If you make 10%, but you lose effectively the same 10% due to inflation, then you made nothing by buying debt from the government, right? So the Fed's going to raise rates until they can start getting out of QT and go back to... Rates need to be high enough so that it's worth for the Fed to print money again. Do we understand that part? That's kind of the whole Treasury part of it. So the Fed needs to raise rates. We all knew that. When the Treasury market was collapsing, and yields were going up at the same time we had inflation. Not a good sign, right? The Fed needs to rapidly raise rates, which they will, but they can't do it yet because it's too dangerous. I always said in the summer, they're going to turn on the afterburners and we will see 1, 2, 3-point raises in a single meeting so they can save the Treasury market and get their yields. And then they can let out of QT a couple years later, go back to buying assets again. That's the only way that they can do it, or else we are going to have the Fed circle around the inflation rate and slowly drive the stock market lower and create a stagflation problem for the government and us. And they're the ones that have to bail us out. And Powell's smart enough to not do that, and I don't think that's going to happen. So ideally, they have to raise rates. We know that has to happen. But then it comes down to, are they going to raise rates now? Is it safe? And if they do, what's the problem that's going to come from it? Is it going to make the problem worse? I believe at this point, raising rates anymore is going to make the problem worse. And I'm going to tell you how, because of the job market. It's a major source of inflation at this point. And the Fed raising rates is not necessarily going to change the inflation rate in this type of inflation. But Fed raising rates is going to scare the stock market into becoming bear market, which they did. In a bear market, companies start laying off, right? People start laying off, you flood the job market that had a shortage of workers with now a surplus of workers. Now people are competing for the same job, and I'm about to show you that, which means when you're competing with someone else, it's now a bidding war. The lower wage gets the job for the same skill set. So when you start laying people off, wages come down. So my initial thought was raising rates. You have to raise rates a lot to... right? To curb inflation in a normal hyper-economic world so that the Fed doesn't deteriorate its own balance sheet because of inflation, right? So now with the Fed rolling out of stuff on their balance sheet, then they don't really have too much vested interest in caring about their own balance sheet as much as they do preventing themselves from having to bail us out if the market collapses. Now, the way you curb this kind of inflation is you just secretly induce a bunch of layoffs. Is exactly what they want to do. Raise rates just a little bit, just a little bit, just a little bit, until the stock market starts laying off 5 and 10% of the stupidity, which was people getting paid double their salaries to go do Zoom calls once a week and pretend to work and not really produce much. That was post-COVID. That's a bubble. And anytime there's a bubble, the Fed has to come in and stop it or else it crashes markets. Do y'all know that that was a bubble, right? Anybody here, raise your hand. Was that you? Is that you now? Don't be shy. You got raises and you hadn't been to your office in 2 or 3 years? My dad's company is giving people money to retire early to battle that problem. AT&T. So when you think about it, they need to raise rates to achieve their goal. The Treasury market, it's the end goal, right? To balance the economy. The short-term goal is to lower inflation by inducing layoffs. So if you start saying we're going to raise rates, the stock market hates that. The stock market's been collapsing, but selling off for over a year, right? And what's happened? Companies are 5%, 10%, 20% layoffs. Great. Wages are going down. You bought an expensive house during COVID. You got fired. You're desperate for anything at this point so you can keep your house up, keep your bills going. You will take whatever job will hire you. And now companies have the power. The supply and demand is reversed. Supply outpacing demand on the labor market will bring inflation down, the wage part of inflation. The shortage part, and there's only spot shortages here and there, certain markets, but pretty much people are all back to work. Things are back to normal. And there's so many people back to work, companies letting you work from home. They've got all the people they need. They've laid off. They trimmed the fat. When you trim the fat, Wall Street perceives that as short-term bullish. Right? Companies will have more cash flow, which is the number one thing that causes stocks to move after earnings, is estimating the free cash flow a company has. Can reinvest in itself, can buy back stocks, can do whatever, can have more profits, more dividends, whatever. Cash flow is what people care about after earnings. You lay people off that weren't producing anything, you were just wasting money as a company. So your cash flow is going to go up. And because layoffs started going up, Wall Street started becoming slightly less bearish. And that's expected, right? Quarter to quarter when earnings come out, companies just look slightly better because they trim their fat. And number two is an overall whole, as we start laying people off, wages come down in general. Right? So the cost of labor goes down, and therefore companies will have to build that into the price of the stuff they sell. They can start lowering their prices for the same effective income as inflation comes down. And inflation was coming down once people started getting laid off. And that's exactly what you saw, which is great. But now there's a problem. Something's changing. And this is the thing you have to understand. You can talk about the job market and predict the CPI. I've hit it every single time. The oil field never lets you have a day off, dude. People are, and the oil and gas that I know are getting, the companies are begging them to stay and throwing money at oil and gas employees to not quit. There's certain sectors that cannot hire people fast enough. Oil and gas is one of them. Medicine is one of them too. Everyone I know in those two industries right now are being offered raises to not go to their competitors. The competition is so high and in such demand for medical and oil and gas employees. Maybe oil and gas is starting to slow down now that oil prices are coming down. For the last year, if you walked up, you worked at Chevron, you walked up to your boss and threatened to quit, they'd give you a 50% raise to get you to stay. That's where we were. Bonuses, stock options, everything. Okay. So let's talk about what's going on in the labor market. Something has changed. JOLTS is the number of job openings that companies are trying to fill. Just the job openings. If JOLTS go up, then there are jobs that need to get filled. If JOLTS go down, there's no more jobs that are getting filled. So either people get the job back or the company eliminates the job, one of the two. Company eliminated a lot of jobs back in here. You had 3 accountants, 2 of them were working from home, 1 of them was working in the office, and you realized you only needed 1. So you fired the 2 and also closed the job down. JOLTS will come down. Another thing is you have 3 jobs and 3 workers, you fill them up, then those 3 jobs are no longer needing to be filled, no job openings. So JOLTS will also come down. So when this comes down, either people are getting their jobs back or company are eliminating the jobs. But the available demand or the available supply of jobs is coming down for whatever reason. So you need more information. So for a while, you know, during COVID, the available supply of jobs went down. Well, why? Because everybody got laid off. Nobody could work. That happened. Everyone got laid off. You can't go back to work, the government says, until we lift the, you know, we open up the businesses, okay. And all of a sudden, the available jobs go up. Way up. As companies start creating jobs, hiring people back, or creating jobs to, or sorry, companies start creating jobs to hire people back. And once they hired everybody back, jobs, such a huge hiring spree, companies need workers as fast as they can to catch up on production that they lost during COVID, right? So they're offering anything they can to people because people need more money to pay for the expensive stuff because of the shortage inflation. So this period, people got paid ridiculous wages. At this period in time, last year, FOMC announced QT because they're going to roll off the balance sheet, the fixed assets because of inflation. They see it coming. They're smart enough to get out of the way. And then number 2 is they're going to raise rates to battle inflation so they can go back to buying assets from the government. Okay. Not raising rates. Any other reason that down the road they're going to want to get back into some treasury notes, you know what I'm saying? So at this point, the Fed steps in, starts doing things. And what this does, it has a side effect. When you raise rates in QT, that scares the market to a bear market. So when companies start laying people off, then people are going to start filing unemployment. And this is the story, right? Unemployment. The first, you ever get laid off from a company? I did in 2010 from Dow Chemical. I was an engineer at a plant. I ran an acrylic acid monomer oxidation reactor as a run plant engineer. I got laid off, got a severance package that introduced me to, well, that was my introduction to trading. So I started trading with that money. And yeah, the first thing I did was when I got to my car, I'm like figuring out how I'm gonna get unemployment. Well, shit, I also got bills to pay. Well, I got laid off. Let me file for unemployment, right? So immediately within that first week of you getting laid off, you're gonna file unemployment. So you could think of the unemployment first time filings are people that just got laid off that week. You got to keep your bills up. You're not going to delay on getting your free money from the government, right? So that's another thing we can look at. So right now, the job openings came down because people are starting to get laid off. Companies have already hired everybody and they're starting to trim the fat. Okay. So during this time, fewer jobs. And if unemployment goes up, it means more and more workers. So now you flip the supply and demand around. More workers and less jobs means that the wages come down. Check. Same period of time. Let's look at it. We're talking about 2021. This is right around the turn, right? Jobless claims were just going away. Everybody got their jobs back. And now people are starting to get laid off. Right when that recession happened, companies were shutting down. Companies were hiring less. Companies are laying off. This is obviously seasonal labor likely. But you can see that people are getting kind of laid off in tiny little droves. Because as the stock market is selling off, shareholders are like, you need to optimize your company. I'm a major shareholder. Well, yeah, we're gonna do some layoffs. We're gonna, trim some of the fat. We're gonna have, and all the companies did. We saw it. The Fed knew that would happen. They're curbing inflation by forcing layoffs. If you guys understand that, that's the kind of secret side effect that this happened. Scared Wall Street a little bit, sought the stock market. A year later, shareholders would pressure the CEO and the board to start talking about layoffs to raise the stock price. Because of that, the layoffs saturate the job market with a lot of people that need jobs. And you can see these waves of unemployment right here on my screen. People are getting laid off. Look at those waves every quarter. Quarterly report comes out, people get laid off. Quarterly report comes out, lay out a few more people. Quarterly report comes out. Every quarter, as I said a year ago, we will see layoffs come in batches every quarter as every company lets off 5%, then waits, lets off another 5% and waits, lets off 5% and waits, and they do that until the shareholders are happy. And the company's back to peak efficiency. Do we all see that on my screen? You see how those waves come every quarter? We predicted that. Because that's exactly what a company is going to do. Lay off a little bit. And they're not going to go dump 50% their workforce. We all saw it. What was it? Microsoft and Amazon. They all 5%, 10%, little by little. Yes, in chat? You guys remember that? And you see those waves of layoffs. Seasonal, but other than that, you see them about every quarter. You see big peak waves and layoffs. Trim the fat, check it out. Trim the fat, check it out. And as you see, those waves have become less and less and less prominent. Initial jobless claims. So fewer people are getting laid off week over week, and it's going in waves. People are getting laid off. Well, those people are finding their jobs again. People are getting laid off. Well, actually, no, sorry, this is the initial jobless claim. So people are getting laid off. Fewer people are getting laid off. Next quarter, oh, we still need to push a few more people out because we didn't hit our targets. Okay, lay some more people off. Lay some more people off. Lay some more people off. So companies are pretty much done laying off. Do y'all see that? Look at that. We predicted something. Layoffs are pretty much over unless the stock market collapses. And when stock markets collapse, if you remember from 2010, let me tell you from experience. Here was the stock market in 2007, 8, and 9. Bear Stearns, Lehman Brothers, market collapsed. And then 2010, market was doing this. In the summer of 2010 is when Papa Bear lost his job, a year after the market bottomed. That's weird, right? Markets are recovering when big waves of layoffs happened. Now, mine was a special layoff situation because Dow went through a merger with Roman Haas. They needed to consolidate their assets, and they had to lay people off because they had to divest some assets. The SEC forced them to, so they wouldn't have. Well, they had to also because of not having a monopoly in certain areas, but they had to divest some assets as part of the merger. So they had two identical plants. They bought ours. Dow thought it was smarter to keep their own folks and lay off the Roman Haas people. That's a terrible idea. We were better, but it's okay. German company, man, they're always so good at their stuff. They overhire smart people, and they always are so fucking efficient. We were in the green during the recession. We were great. So anyways, I was a new kid. 6 engineers, they let 3 of us go. Back to the story. The big layoffs happen after the market crashes, and companies just need to give themselves a boost to start fresh. So the trimming the fat layoffs are over. Do we see that on my screen? Those prominent waves of layoffs are smaller and smaller and smaller. Companies are now as efficient as they think they can get. It's been a year or so of this, and you can see that nobody we've hit kind of like a stagnant period, right? We all agree? Can you see that, right? Each one of these bars is how many people filed for unemployment that week. So each one of these bars, just think of that's how many people got laid off that week. So as the quarter goes by, you see that there's more and more and more and more layoffs, right? Just companies are gauging their performance quarter to quarter. And that's how you can see the fact that these peaks are a quarter away is a sign that shows that you're going to lay off a little, see how you did. Lay off a little, see how you did. And right now, this is a sign that layoffs are over. So like we can start building a thesis, right? Layoffs over. For now. That's not even close to how you spell the word layoffs. Over for now. Okay. You need a big event to trigger more layoffs. So the layoffs are what brought inflation down. Let's check, okay? So the Fed induced a few layoffs, and now we look good, right? So let's see about one more thing that we look at. It's the continuing jobless claims. These are people week 2 and onward who can't get their job back. Imagine that you need too much money for your salary. You're asking for too much. Or you're just a terrible worker. You got fired because you were lazy or you didn't do anything, or you just weren't cutting the bill and you can't get a job back. Now, for a while, that was okay. Remember, the continuing jobless claims, this is how many people are still on unemployment after the first week they file. And this is people getting their jobs back in post-COVID world. And then right here, you have this very interesting phenomenon where there are people who can't get their jobs back. They got laid off while companies are laying off more and more people and layoffs have stopped. Look at that buffer of people right there who can't get a job right now. Do we all see that? That was the Fed's goal. This right here. It sounds very morbid, but they wanted to saturate the job market. This is it, saturate. With people that need too much money for their labor and companies don't care to pay for it. As those waves of layoffs have pushed people into the open labor market, now there's a huge amount of people still filing for unemployment, and this line is flat. They cannot get their jobs back. Do we all see that? Everybody, do you see that? Continuing unemployment. This is people that are filing week after week after week after week. It's the same number. It's the same number because we just showed no more people are getting laid off, and the people that are laid off can't get a job. They're sitting there unable to work. So let's look at what the jolts are now, the available jobs. Why can't they get a job? Well, maybe there's no jobs that are available. Wait, the jolts have been going up since October. generally speaking, slightly going up. Companies are now opening jobs. This is the problem. This last 6 months, there are more jobs available. Jobs going up. Layoffs basically stopped. And workers that need jobs, right? Because they're behind on their bills, also going up. It's a problem. It's a good problem, though, for a little bit. Tons of jobs available and tons of workers that need jobs. Supply is high and demand is high. Why can't these two connect? There are jobs available and people need jobs. Why aren't they getting their jobs? They got laid off from the company. The company doesn't want to hire them back. They weren't good at their job for the amount of money they want. So this right here is going to collapse wages. As those jobs the worker will take whatever they can get to get in those available jobs. As the amount of jobs go up, it means that the companies only want efficient workers or cheap workers. Companies are now trim the fat. They're only going to bring people back if they're going to do their job very well and efficient. Jobs going up and available workers there, and companies are like, we don't want you. Companies are picky right now, very picky. So it's really hard to get a job. So the economy is going to slow down because there's fewer people with money to spend. It's fewer people putting money in their 401ks. A lot of people on unemployment. Companies are picky and saying, we don't care. We're going to rough it out until we find better workers or until you want a less wage for your job. Skill mismatch, possibly so. These are bulk statistics, so maybe the amount of jobs that are available might be tech jobs or something when the amount of unemployed people, the jobs available could be medical jobs and oil and gas jobs, and the amount of unemployed people could be tech workers. The job mismatch, skill mismatch, that's another reason. Silk, you nailed it. It's two things. So either A, people want too much for the job, or people aren't right for the job. Companies say you're not right for the job. So it could be that the people that are laid off, you have to dive deeper into the Bureau of Labor Statistics to see the numbers, but basically the people that are unemployed don't fit the bill. Companies need workers and the available workers aren't good enough. Whether it's they want too much money, the company won't pay, or they don't fit the bill. They're not skilled enough, or they're a different sector. You need this kind of employee. You need a doctor and this person's a lawyer. They don't fit. So there's a mismatch, right? Which all it means is don't try to dig too deep into it. It means that it's going to be really hard for companies to hire the people they need. Now, the fact that companies are opening jobs, it means they have the cash flow to pay for it, don't they? So the idea that jolts are going up and companies can be picky, why would you open jobs? Because your company's growing. Congratulations, you have free cash. You trim the fat, now you have money to spend. You can hire people back, but you're going to hire the right skill at the right price. Sound like Academy. Your tech background doesn't really fit here at Wendy's. Hilarious. So now we're thinking about where we are right now. We're at a place where companies are growing, they are opening jobs, and we have a place where people are unemployed and can't get the jobs they want. So companies are doing better, but there are fewer people with money to spend. And with interest rates going up, the cost to borrow money is getting even worse, and you're unemployed. It's really hard if you get a loan. So the economy is going to slow down very rapidly from spending while companies have money to spend. This is a weird mismatch in the economy right now. It's a very sticky situation. If the Fed presses too far on interest rates, you could cause a panic in Wall Street that sells the market off further, which will induce more layoffs, which means that little sink of employees who can't get their jobs back, you're gonna have more of them. If the market starts to collapse, well, companies are gonna go under, and you're gonna have a bigger saturation in the labor pool, and then it's gonna cause a chain reaction, a bigger recession. It's gonna be harder to fill those jobs because companies are getting shut down. So the thing is that there's a really finicky labor market right now. It's a skill mismatch. Half of it is, right, so there's a labor mismatch. Half of it's the skill, half of it's the wage, I would say. You can go look through the data, and you can see that a lot of the unemployed folks. Certain industries are just doing bad and certain industries are doing good. So that's number one. Number two is with QT still happening, you know, you have the full effects later this year. That's a variable that we don't understand. We haven't had that in a while, right? With more people unemployed, the expansion of the economy or the spending goes down. So economy doesn't grow as fast. With QT, with less money out there and assets, companies don't have their share values or asset values don't go up as fast either. So there's two major forces slowing down the economy. Layoffs, people can't get their job back. They want high wages. And then the Fed, QT. Two big factors already slowing down the economy. And see, when you raise rates to induce layoffs, you have a side problem. You start putting pressure on banks and things like Silicon Valley. Now that banks are collapsing, you have to understand the cost to borrow money goes up when rates are raised. So if you keep pressing this very fragile bank market, you could have a repeat where investment banks collapse. Investment banks that are already very, very, very on the fence because they've invested in a lot of these things like mortgage-backed securities and things that are now deteriorating because of inflation. Yields are deteriorating. So companies or banks are already stressed out enough. If the Fed presses too hard, too fast, while banks are collapsing, that's why I think an immediate zero is necessary. You have the stall in the labor market. The economy isn't growing. When you're not working, you're not putting your 401k money in, so you're not buying stocks. The stock market's more depressed. Raising rates scare the stock market further. Stock market sells off. Layoffs get worse. People get laid off. Stagflation is here. You won't work. Well, that's soup kitchen recession at that point. You don't want that. The Fed has to let banking and finance stabilize right now. That's the kicker. Banks collapsing. The Fed needs to stop raising rates. And 25 basis points is not enough. It's not the amount. It's the testament. If the Fed says zero, they're saying we're watching banks. That's exactly what it means. And I bet you this press conference today, Jay Powell's going to say nothing except for labor market and banking. I'm forecasting what he's going to talk about. Yeah, that's my thesis. So that's the whole. So how am I going to trade the Fed? Now I have a thesis. I'm going to bet that the Fed's not going to raise rates at all. Right? People want too much money or skill mismatch for the job, and companies are being too picky. The Fed kind of overshot. They're going to probably side with the worker at this point. If they go to zero, Wall Street's going to be somewhat bullish. Zero rate hike, right? Wall Street will be somewhat bullish. How many stock prices are going to go up? And the company will say, look, I only want to pay $80K for this job, and I know you want $200K. I'll meet you in the middle, $120. Our stock price went up. We can afford it. And that's going to get people back in their jobs. If the Fed goes to zero, it's going to put people back into their jobs. It's going to put liquidity back into the markets while the Fed's trying to withdraw liquidity from the markets. And that will balance that out. And then once that balances out and the economy grows, then the Fed will rapidly raise rates after QT is fully realized so that they can drive inflation down and get the yields back outpacing inflation. And then they can go back to buying assets, and then we're back to a bull market. If I was FOMC chairperson to do the same thing, I would immediately go to zero today and shock the market. The reason the funds futures are pricing in 25 is because that's kind of the anticipation. But if you shock the stock market and go 0, 0, 0 until the summer, and then you go 50 and then 1 and then 2 and then 3, they get that effective rate up to 12, 13, 14%, which they will next year. Bet my word on that, or bet your mark on that. We'll see 10 plus by the end of this year. Not gonna lie. They've done this before. Raise rates, slow down, raise rates quick. But in this environment, in the 80s when we had something similar, the market was bullish even against those rate hikes. Because the rate hikes weren't doing anything. People got their jobs back. They didn't need to be so desperate to live on credit. They can just live off their wages. They got their jobs back. Companies are being too greedy right now. They're being too picky. They got their share prices stabilized, and they don't want to hire the workers that are available. So the Fed doesn't want to induce any more layoffs. They can't raise rates that aggressively. We called that. They started trimming last year because of that. Layoffs stopped. The minute Fed started going 75, 50, 25, y'all saw the layoff wave stop, didn't you? That is exactly what's going on behind the scenes. They don't tell you that because it sounds pretty morbid. People will picket in the streets. Jay Powell's doing this to get me fired? Wow, he was. And really, he was. You have to understand that. But for the greater good. You wanted too much money for your job, and the company had too much money to pay you because the stock price of the massive short squeeze after COVID gave companies so much money they were so desperate for workers. This is all in response to the government shutting down everything during COVID. This is exactly what happened to it. So it's a very tricky game the Fed has to play. They need to continue to raise rates. We need to go at least 10 plus total. I would say 13 to 15 will be where we end up. Do y'all disagree with that? It's a pretty good place. We'll get there. Yeah, we haven't seen that in a long time, but it's happened plenty of times in the past. It's necessary. Very necessary. As Alan is saying, banks' P&Ls are tanking. Banks are the problem. If you start having bank collapses, there's all these memories of 2008. If a bank collapses and the Fed has got the afterburners on, you know other banks are going to collapse. Banks get stressed. They can't maneuver. They can't be as liquid. They can't get as much money from lending. They have to be stricter with all kinds of problems happen when interest rates go up. Banks get stressed, and if banks are failing, the Fed knows they've pushed too far. The stock market collapses, everyone gets laid off again, and we're back to square one with COVID. Market shuts down, companies shut down, everyone's laid off. They need their jobs back. But now there's inflation to go with that. Now you got shortages again, and now you have hyperinflation, and everyone's unemployed. We will never recover from that. You know, buy your chainsaw and your gas can, your lawn chair now. The apocalypse will happen. The Fed cannot drive the stock market to zero because the stock market will indirectly induce layoffs from stock prices going down. Shareholders will press the board and press the CEOs to lay people off. Production will slow, and we'll hit a massive inflation. Massive recession. It'll take 10 years to get out of. Just watch this video. It'll be saved. So the idea is that the FOMC needs to raise rates, but they can't raise them too fast. They raise them just enough to lay off enough people so wages come down, and the CPI comes down because of that. Okay, that's that surface number that people want to see. So let's predict that the CPI is going to go up or down really quick. Let me look at this. Kind of like that surface level. And recently, they've changed the calculation on that CPI year over year, so it stops looking so far back in time. It only looks back through a year worth of data. Look at this. CPI is going to, as long as people need jobs and don't get the jobs, you have that stagnant thing where companies have more money because they're not spending it on those jobs. Market's slightly bullish because of the cash flow. People need those jobs. Companies start hiring people back. Market starts trading down again, and companies will make less money at the end. You invest in a worker, there's like a delay before they start producing, right? There's always a couple of months before they're good at their job and start pulling their weight, or even if they do it all. So right now, with CPI number on the surface coming down, there's that little magic trick where they changed the equation a couple months ago, January. So it looks back less far, so the year over year don't have as much of a drastic change. That's to make the CPI number look better on paper. Okay, whatever. Either way, Wall Street reacts to this number. If you pay attention to the press releases, this isn't the same calculation that it has always been. Year over year is the difference between 2 points a year difference. But those individual points always look back 2 years. Inflation data, right? And they're only looking back one now. What effect this has on the housing market? Well, yeah, I always, like I said, I'm not a genius at economics. I piece everything together with logic. What's your motivation? Why are you doing it? And what are you supposed to do? What are you telling us you're doing? Right? It's reading a poker player. Are you bluffing? Do you have a hidden agenda? What's going on? So the housing market, well, I don't know. Let's think it out. Housing went up because the cost of materials went up. There were shortages. You couldn't get windows and doors and paint and all that stuff. There weren't even painters and carpenters available. you could still get loans for land and loans for houses. People are easily getting houses even though they were laid off during COVID. So that rapid development had all these builders go out and jump in to try to cash in on those inflated house prices, right? Prices went up, and the housing prices were all going up around. So builders massively started building, saturated, right? Empty plots of land with tons of houses, and then jacked up the price, and people started buying them. And now people can't buy them as easily. So first and foremost, builders are struggling, and I know because I know people that are real estate agents for builders. It's harder for them to flip those houses. For a couple of years, they were making bank. They could sell every house that was ever built at double the price. So now building's probably normalized. Harder for people to get houses, I would think, because unemployment is going up. It would seem that if I was a bank, I would take that into account, and I would make it harder for people to get loans. I would make it more costly for people to get loans because the risk is high. We're in a recession. It's probably harder for people to get houses, which means those inflated prices should be coming down. I don't think the housing market's going to collapse because there are available jobs and people need jobs to pay their bills. At some point, one of the two is going to buckle. Either the people are going to take less money or the companies are going to pay more. So I don't think people are in too big of a pickle as far as like paying their mortgages and defaults. I'm not like Michael Burry, and I don't investigate like the actual mortgages and the bonds to see how it's going. But I'd have to say, like empirically from the people I know that have houses, I don't know anybody out there who are struggling to pay their bills, at least in my circles. Not all my circles are like, you know, rich millionaire people. Like nobody in my family, nobody in my friends, nobody that I just know is in dire need. Everyone's kind of doing okay. So it doesn't feel like people are trapped like in adjustable rate mortgages, right? So I don't, just on the surface with what I do know, it doesn't feel. So I would say that the housing market is just going to continue to come down, and like prices are going to come down. We're noticing that. We were looking at houses ourselves, and we see that every 2 or 3 months houses are coming down in value. Like people are trying to get out of the house. And that's another thing too, is that in a recession, you know, if you bought a house that's expensive and you know bills are tight, you might want to get out of it, and you're going to get out of it desperately. So we're actually trying to bank on that and looking for a house ourselves right now. Right. We're eyeballing some houses. There was one we looked at. It was like, what was that one, babe? That one that we saw. What was the price difference? That one with the blue cabinets that we liked. How much did it come down over the time we were looking at? The one that's on contract now. How much did it start off at? 1.2? From what? Yeah. So we're looking at a house that was 1.2 mil, and within what, 6 months or so, it went down to like 980, and then it got sold. So think about that, right? People kind of need to get out of these expensive houses, so that's a stress. So I think the housing market's going to come down a little bit. I don't think it's going to collapse, because I don't think the people that are selling $1.2 million house are not going to be the same as like people with terrible credit scores locking into adjustable rate mortgages where the mortgage goes up double the value next year. Or the rates go up double, sorry. So like housing market's going to decline like everything else. There is, it's a good time to buy if you have cash. As things fall down in price, it's a great opportunity for people to come in and get something, right? But it's still bleeding off that inflated housing price. It's all built in with those high labor, high material costs. So I think labor's coming down. I mean, housing market's going to come down too. I don't think it's going to collapse. But the problem is the housing market coming down does put some stress on those mortgage-backed securities, which doubles the stress down. The risk of defaults are going up. But I don't think we're going to have like a default frenzy unless layoffs go up. This current wave of layoffs is creating a wave of people selling houses for sure. We're eyeballing to go invest, or go buy a house ourselves. When you think about it, we're just in a place where the market is very finicky right now. Fed can't induce any more layoffs. There's people that can't get their jobs. Imagine more people that can't get their jobs, right? The economy's in grind to a halt. And those people can't borrow money because banks aren't lending it out because interest rates are high and risk is high. So those people are stuck, and that will cause a crisis. As things that they're paying for, they default on loans. And so if the Fed continues to go hyper aggressive now, I'm going to bet they're not going to raise rates until those people get their jobs back. That's one whole hour for me to come to that conclusion. I'm going to write it on my screen and leave it here till the meeting. And let's see if Powell actually says that. I'm going to take a guess. Rates change equals 0 until continuing unemployment. Right? That stagnant buffer of people. Go down, which means jobs must offer, or companies must offer, and that's going to come from two things, right? Companies have to either pay more for the job or workers have to want less for the job. CPI is coming down. There's no reason to continue to battle surface level inflation numbers. The battle has been won. Now it comes down as a battle for the real economy and battle for the treasury market. That's not going to go print money and create a massive bull market if the yields are dog shit. They're not going to ever go into QE if the yields deteriorate fully due to the inflation. There's no reason the Fed would ever buy anything from the government until inflation is to their liking. And so the long-term goal is to drive inflation further lower. But if they drive it too far now, they'll create a recession that we won't be able to get out of. So my prediction, this is building a thesis, right? My prediction is this, right? March, 0, maybe 0 or 25. I'm going to bet we get a surprise on 0. And I'm going to go back to my trade in a second. I know I talk a lot about this. This is what I think about when I'm not trading, though. April, 0. May, 0. June, 0. July, 25. August. August, September. 1 to 2. I know it sounds crazy. We need to save the banks, save the banks, save the banks. In this time, people go back to work, back to work, back to work. There's liquidity in the stock market. Stocks won't collapse. Companies won't lay off further. Let's get workers back in their jobs. Okay, bam. Workers want more. Companies want to pay less. Let's get that. Meet them in the middle. Okay, go back to work. Make some shit. Let's go. Look, banks. Everybody has their jobs back. Now you can lend them money. The risk is lower. Lending goes up. Economy is saved. Great. Now we're in a bull market and the Fed says, great, we're going to raise rates. Fast. That's it. That is it. That is it. The Fed is going to aggressively raise rates. They need to. They have to. And people say that. Here's the problem. People don't understand the complexity of doing that right now. If you raise rates too quick right now, think about the effect. Stock market goes down. People more bearish. More people get laid off possibly. More people can't find jobs. Lending is riskier. More banks can collapse. Do y'all see that chain reaction? If you scare the stock market any further and asset prices deteriorate, more banks could collapse and there's a market crash, right? That's what caused the last market crash. That wasn't COVID, the 2008. Do we all see that chain reaction? So when banks started collapsing immediately, if Jay Powell doesn't go to 0, he's a dum-dum. If anything, I know this is, I would very much find this to be very hokey to do. If they need to jolt the stock market to push those people in those jobs, it'll cause inflation to go up slightly a bit. They'll actually go and cut rates. Would be enough to stimulate a very short-term bull market for a quarter. I don't know if they'll do that, but in a desperate move, they can trick Wall Street into raising rates. Remember, companies' stock prices go up, they'll hire people, pay more money for them. We got to get those people that need jobs and the companies that have jobs. Y'all see, we have to get them to meet in the middle. Productivity is going to go down. Supply is going to go down. Price is going to come up. Also, people are putting less money in the stock market. Less liquidity in the stock market. Stock market's more volatile, more sensitive to news, more sensitive to things. Banks are more sensitive to risk. Changes in asset prices can put banks into a very bad position. And a bank crash would create a chain reaction and get everybody unemployed again. Do we all see that chain reaction? The Fed must slow down for a little bit until those people can go back to work. That stabilizes the stock market, A. Stabilizes the wage market, B. Which brings inflation down. Fed's achieving their goal. Stock market's not so crazy. Nobody else is getting laid off. Companies are producing stuff. More stuff means more supply. Prices come down even further. Inflation comes down again. That is the best approach. There's no better approach. This is all psychology at this point. 25 basis point is a mean dick when the rate's at 5. It's nothing. That's nothing chump change. The Fed needs to get rates above 10 to really put the nail in the coffin on inflation. But that goal is a longer term goal. If they go there now, they're going to crash the stock market. And that's the battle. Go too fast, you crash the stock market, you kill the economy. You go too far, or you don't go far enough, you crash the bond market, and you destroy the government's ability to have money. And your ability to have money. And no liquidity anywhere. Fed never comes back into QE for a long time. So it's you can't go too far, you can't not go far enough. You are stuck in the middle. Rates must go up, but they have to pause now. There's my thesis, is 0. So let's watch this. 0 is a 15% chance on Fed fund futures. That's the less probable thing. If 25 happens and the market rallies and dips to my bull zone and Powell starts talking and says anything about these things I said, I'm going to long and bet that we get 0 in April. If it's 0, we probably dump. So I'm expecting whatever we get now to be 0 or 25. Maybe 0 just to save, face and keep the stock market and the banks okay. But if not, I'm listening for hints of 0 of April. So the choices I have are number 1, 25 now. Press conference says 0. Press conference hints 0 April. Because of these points I've made right here. We need to stabilize the labor market. We need to save the banks, right? We're watching banks. We're watching financials. So press conference looking at 0 in April. So point number 1 is 25 now will probably have the market do whatever. And then, I'd want to long somewhere on the belief that we probably get 0 for April, or a hint at 0 for April. That'll come in the press conference. Number 2, yeah, like you said, what happens if we get 0 now? Well, that's the least likely thing. Fed funds futures have pushed away from the probability of that from 50% to about 15%. So what are we doing with that number? Well, the unexpected thing happens. 0 will probably rally and maybe sell off. And then the press conference again will be the deciding factor. So I would take a guess that a 0 right now, knee jerk would be very bullish, right? And it's probably a long to D band. And if the market hits some level, starts to sell off, and then we do like something like this, and then the press conference starts, and then if Powell starts hinting at 0 again, and we're like that. 0 March, 0 April, It's going to be that. 0-0 is hella bullish. I mean, there's no way that wouldn't be bullish. So what I would be very cautious with is longing on 0 to the top. Somebody may see that as just a knee jerk to save the banks, and April might be where the afterburners come on. What I want to see is 0 hinting at 0 next time. If it's 0, we dump and dump. People don't want to work. That's not happening. Well, that's how I would perceive Wall Street trading this. 0, we dump, yes. Stock market is going to support the bull zone, very likely. So if the Fed goes 0 now, futures are going to start pricing in 0 for April. It's the April pricing that would cause a rally today. If we dumped, I would agree with you. It would be over time. It wouldn't be after. It wouldn't be that day of the press conference. Ski the money man. My thought would be you're correct. The timing would be the Wall Street knee-jerk reaction on a press conference hinting at 0 would be a rally today, and then tomorrow it probably dumps. Yeah. Because people will now start to forecast, geez, the Fed has to go to 0. There must be a big problem in banking, right? So again, market's always trying to get ahead of something. Today's trade, I'd like to see 0 hinting at 0 in a long off bull zone, just to take a rally to the top. Trade all your capital today? Cool. How'd you do? Oh, let me respond to some of my messages here. But I try to think of it like, need 3%. Oh, nice, dude. Nice. Nice. Man, there's a lot of people did their poster set up in my post up there. Dang, 12,000 impressions almost. Jeez Louise. Oh, I got a nice little tweet here from. That's the way to do it. Cool. All right. Remember, guys, check out the extended trial for our thing. It's awesome that you can join this. Join our family, $35 a month for 3 months. It's like 83% off, and that's been very popular. Just go through our training, learn everything we have to teach, and you got risk management to go with you for the rest of your life. Trust me when I say Rocket Scooter's business plans are going to change this year. You will see drastic changes in where we go as a company. The things we have planned are for ridiculous scale. Okay, so understand that you kind of want to get in at 35 or lower than 199, because all of you that are in our extended trial, we're gonna give you all a special little deal very soon, that if you just lock in, you get a low rate like our OGs, similar for life. So we want to reward people who jump in early with our stuff, learn our process, learn what we teach, fundamentals, day trading, risk management, everything, options trading, stocks, futures, we teach it all. Rocket Scooter platform will have all your full data feeds, scanner access, watch list access. We're building all of our tools going forward. We have all kinds of stuff, portfolio management, analysis. We're gonna have live trading futures, and in this next, coming up this quarter, we're gonna have futures data coming up. We're working on that now. All kinds of fun things. And then phase 2 of Rocket Scooter kicks off. Oops, let me take a picture of that. Which phase 2? Something I can't talk about. Well, let's just say things are gonna be really different at that point. magnitude's different. Just keep that in mind. No trade live every morning. I usually do, yes. For 1 hour, I trade live every morning. I do different challenges. Things I mostly do are trading challenges. So like right now I'm in the middle of doing a 10K to 100K challenge in my personal account. It's currently at, I showed it this morning. Let me show it to you again. They always show full transparency, all the details. I've done like, I take a small account and grow to a big account. And I just kind of show the entire process, the journey, the stats. This is where it is now. And I'm also simultaneously kicking off a partnership where I can, we have this group, Elite Trader Funding, some friends of ours. I'm just showing off if I can pass the really strict demo process or the evaluation process on 2 different types of accounts, just to demonstrate how to do it for people who want to do it. This is the 10K. It's currently almost at 21. So I'm up, whatever, 110% on that journey to 100K. I trade live front and center for an hour. Then I spend the next hour or two in the Discord talking to people. And then I go to a Zoom call and we do training, trade reviews, trade plan reviews, et cetera, et cetera. Oh yeah. I have Ashton Nolan. He's also a partner in this group. He has extensive knowledge in options day trading, and swing trading, a lot of stuff. And he's teaching courses now as well. So I kind of do futures and indices. Ashton does stocks and options. You get a little bit of everything. Swing trading, day trading, all this stuff. Do I recommend Tradeovate? Think about signing up to trade futures? Yeah, Tradeovate's great. I like them. I use them. When Rocket Scooter can trade futures, we will have different broker than Tradeovate. So obviously, you can choose any broker you want from our list of brokers when we have futures trading. And Tradeovate won't be on that list, unfortunately, but we'll have pretty much anyone else. But Tradeovate is amazing. I love them. I've always loved them. I'm a big fan of the company. New Tradeovate accounts will have to pay $60. I wish they would let us patch in. That would be great. Rocket Scooter has hundreds of thousands of subscribers. Once we hit our scale up, I think that'll be warranting a talk between me and Rick and seeing if we can't get them to open their API to us. We'll see. APIs are closed since the Ninja merger, so we don't know. But obviously, you'll have to like you have a brokerage account with like Phillip or Darman or something, you can trade that through Rocket Scooter when we initiate that. For now though, like I'll always have a Tradeovate account. I mean, I love trading. It's easy, it's fun, it's a mobile app. But I'll be trading through Rocket Scooter at that point. Is there any promo coming? That's the promo, $35 a month for our full unlocked $200 a month package, the full experience. Take a taste for $35 a month for 3 months. It's an extended trial. You can learn our whole program, JP. Like this boxing and chart, clean design it. I did. I built this entire thing. Or my company did, but like CEO of the company. Well, people outside the US be able to trade with the Rocket Scooter. It depends on your arrangement and the exchange limitation to people outside the US. That's a question I could answer because I don't know all the jurisdictions and what is and isn't allowed, what you can trade. That'd be between you and the exchanges. So you'd have to answer that question yourself. Just imagine we will have futures, options, stocks, crypto, Forex trading as the years go by in that order. Futures, then options, then stocks. Or sorry, futures, then stocks, then options. And so you'll have to figure out if that broker allows to trade on. I don't know all the legalities of that. That would be up to you. Join someone's cool, GP. Awesome. We're just gonna wait for Fed. We've got 2 hours till it happens. There's really not a lot going on. I made a scalp, easy scalp out the door. S&P traded up to a red line, which cleared that out. We have markets nice and stable between DD pans. We're sitting at the April triple B. I'll be very careful. I'm gonna wait for some volatility to come out. Let's reconvene at 1 o'clock, 2 hours from now. Let's let the market move, do its thing. Nothing's gonna happen until FOMC. I'm looking for 25 hinting at 0, 25 hinting at 25, or 0 hinting at 0. Those are the 3 options that we think of. I think the most appropriate, predictable thing is 25 heading at 0 or hinting at 0, but I'm predicting 0 hinting at 0 in April. As the Fed is going to react very rapidly to banks collapsing as a quick change overnight meeting kind of thing. You know, we need to do something now. 2 banks collapsing Credit Suisse possibly collapsing. UBS had to buy him out. You know, I mean, come on now. I mean, remember when, like, was it Wells Fargo or Chase? Somebody had to buy Washington Mutual, whoever it was. I forgot. Maybe it was JP Morgan, I think. Like, when banks are buying other banks, it's a problem. Doesn't mean the problem goes away. You buy a bank with risky assets. Now their risky assets are on your books, right? The problem doesn't go away when a bank absorbs another bank. They now hold the stress and weight of those assets, right? So you gotta be careful. Well, that's the one time I do like to trade past 1 o'clock. Now, again, yeah, markets are random and there's a possible catalyst. So I'm going to use my wits and trade very small, maybe some micros, and only trade off of bounces on bull zone bounces or hedge pressure bounces. Ideally, I'd like to grab a... I'm about to sneeze. I think that we might get some knee-jerk thing and the market will sell. And I think we're going to bounce either from here or there or there. So we got a huge range for me to play in. I think I'm going to expect hedge to break. It's really tight right on the edge. I'd like to get long off a DD and definitely long off bull zone. Ideally, if I blink my eye and we wake up down here at bull zone with 83 DD, I'm putting some contracts on that for sure. Thank you, Shay. Badass, best Discord platform. Love you, Fausto. You the man. Will be no class today. Yeah, there's nothing to talk about today. I don't know. I think it's time to just relax, take it easy. Everybody get some lunch. Come back. We'll start 30 minutes before FOMC. So an hour and a half, I'll jump back on YouTube today. It'll be for the public. We'll do a public thing today. Everyone check out that trial. We love you guys. Want to see if y'all give it a shot. And I'm going to just chill. Okay. All right, we'll see y'all later. Okay. Check out that extended trial, guys.